Good morning, everybody. I am Karthik Sharma from Elets Technomedia, and I welcome all of you in Elets Financial Services and Insurance Summit. It is a one of its own kind of virtual summit where you will see various financial services and insurance stakeholders together on one platform, stressing upon the need of innovations, technology innovations and non-technology innovations in the financial services and insurance sector. This two-day event will have more than 10 sessions with who's who and top leaders of this industry, financial services and insurance, participating, deliberating, sharing their views on various important and significant topics in this sector. So let's start with the inauguration of Elets Financial Services and Insurance Summit. And I welcome Dr. Ravi Gupta, founder and CEO of Elets Technomedia and editor-in-chief of Banking and Finance Post magazine. Banking and Finance Post magazine is partner in this event, one of the publications of Elets Technomedia Group. So I invite Dr. Ravi Gupta to please come on screen and welcome the speakers, the audience, and everybody in Financial Services and Insurance Summit by Elets Technomedia.
Namaskar. Welcome everyone. I am Dr. Ravi Gupta. I am CEO and founder of Elets Technomedia Private Limited. Elets is an organization which has been disseminating the ideas of innovations for the last 15 years. And we have a very strong focus on the banking and financial sectors. And today, I am proud to welcome you all at the Elets FSI Virtual Summit, a two-day long congregation of experts from across NBFCs and insurance sectors. We all realize that the importance of both the sectors, insurance and NBFCs, has increased dramatically in the COVID situation. While people are looking at the health insurance as a very, very important aspect, and they are approaching the health insurance companies in a big way in the COVID times, the NBFC sector has emerged as a very strong pillar of the economy, which is a savior for all the MSMEs and small enterprises of the country. And while this financial services and insurance sector, FSI sector, is playing this important role, it is also embracing the digital technologies in a big way. The FSI sector anyway has been highly dependent on digital tools, digital technologies in a big way earlier also. But after the COVID situation, a lot of customer interaction, a lot of sales, marketing is going much more digital. And the COVID has brought another aspect, the aspect of work from home. And that is also pushing new boundaries of usage of digital technologies from the work from home ecosystems. Keeping all these issues in mind, Elets has endeavored to organize this two-day FSI summit. And you will see that who is who of this sector are participating in this summit. And a lot of deliberations are going to happen on various aspects of adoption of digital in NBFC and FSI in this summit. We at Elets are thankful to Thales and Raha Infotech, our cybersecurity partners, and Neosoft, our associate partner, for supporting this event. And uh, uh, I also wish to invite you all to look at our website www.eletsonline.com, which is a repository of innovations in the banking and financial and the insurance sectors, and also in the sectors of health, education, governance, and several other aspects. So with this, I welcome you all. Thank you, and I uh, request you all to enjoy this summit, learn, and also network with our delegates and speakers. With this, thank you very much. I'm signing off, Ravi Gupta here again, and welcoming you all here again at the HSI Summit organized by Elets Technology. Thank you.
Thank you, Dr. Ravi Gupta, founder and CEO of Elets Technomedia, for the welcome address. And I would like to inform you that the first day of this summit is focused on NBFCs, non-banking financial companies. And the second day of this conference will be focused on insurance. So to continue with this conference, I invite for industry presentation, Mr. Raman Agarwal, who is co-chairman of Finance Industry Development Council.
Good morning, friends. Welcome to this summit organized by Elets Technomedia. Let me thank Elets Technomedia for giving me this opportunity to share my thoughts at this important virtual summit on NBFCs at a very, very important juncture when all of us across the world are facing what is known as a black swan event. So, friends, having spent almost my entire professional career in the NBFC space, which now runs over around 29 years, I think it will not be wrong to say that I truly consider NBFCs as the Iron Man of the financial services sector. I say this because of certain facts which I would like to share. See, the sector has seen some real challenging times in the past, and many a times this has happened. Although, yes, agreed, this is a global pandemic, global event which has affected each and every person across each and every nook and corner of the world. But as far as NBFC sector is concerned, we have seen very, very challenging times in the past also. Starting from 1997, when the entire regulatory system was overhauled, going down to the Asian crisis in 2002-3, led by the global economic crisis. It was what is known as the subprime crisis in 2008. Then 2014, post the Usha Tharad committee, there was a total overhaul of the regulatory framework for NBFCs. Then we saw another episode in 2018 when one of the leading NBFCs unfortunately defaulted. That created a lot of ripples in the system. And now, of course, 2020, the global pandemic. Now, why I narrated you all this dateline is important, because every time such an incident or such episodes have happened, unfortunately, there have been question marks raised on the existence, or even earlier, the need for the NBFC sector, although that is history now, because right from government, RBI, and everybody fully recognizes the need for NBFCs. Nobody questions the need. But yes, solvency of NBFC issues is often put a question mark, and surprisingly, you must have seen that post the ILFS default in 2018, we've come across some very, very strange press reports which often quote some 1,000 crores of rupees of liabilities maturing within the next 2 months, 3 months, and then putting a question mark whether NBFCs will be able to meet it. It is unfortunate, and time has proven that every time NBFC sector has come out stronger. It has come out stronger, healthier out of each crisis. And I have no doubt in my mind, absolutely, that post COVID-19, you will see a far more vibrant, emergent, healthy, and a strong NBFC sector emerging. There is no question about that. See, if you talk of defaults, I think you would all agree defaults happen in each and every, whether default you could call or wrongdoings do happen in every sector, be it any segment of business across the world. And if you talk of defaults in the financial sector, I think you would agree, even the banking sector, we've seen defaults. But yes, those have been equally supported by the government, timely supported by the government, and very rightly so, because banking sector is the backbone of the economy today. So the bigger point, larger point is that instead of every time trying to question the solvency or the ability of NBFCs to meet liabilities, I think what is better required is to dive deep and look at the concerns, why these challenges happen. Of course, COVID is a different phenomenon, as I said, but there are certain challenges, even this pandemic times, which are peculiar to the NBFC sector. So I think it is important now to move on what brings these challenges, and why NBFC sector concerns sometimes tend to be unique. See, being financial intermediaries, where our raw material is money, our final product is money, we borrow money and we lend money, and this interest rate spread is what is our profit. Now we are, for once, let me also put to rest all such debates which I totally disagree with, that NBFCs are subject to light touch regulation. I think that is a total myth and a misnomer, because NBFCs today are almost regulated at par with banks, especially if you look at the asset side of the balance sheet. And all key parameters are fully regulated. So I think it is wrong to say that NBFCs are subject to light touch regulation. Now, often, as I said, NBFCs being intermediaries are found short of funds. So funding or liquidity is one which has been a constant challenge, more so for a very large universe of small and medium NBFCs. If you look at the sector today, out of 7,500 odd NBFCs, more than 90% in numbers are small and medium. ILFS, we saw a major upheaval and there was a major liquidity crunch which hit the sector. To give due credit, I think both Government of India, that is Ministry of Finance, and RBI fully recognized the need to support in terms of providing liquidity. A lot of steps were announced, whether it was TLTRO1, TLTRO2 by RBI, on lending through priority sector by RBI, coordination of loans by RBI, or whether it was put by the Ministry of Finance, whether it was the Partial Credit Guarantee Scheme 2.0, and under the Atmanirbhar package, recently we saw the Partial Credit Guarantee 2.0 and Special Liquidity Scheme floated exclusively for NBFCs. So efforts have been made, and we must give due credit, because that is where one thing is clear, that both the government and RBI fully recognize the importance and the key role of NBFCs, especially when it comes to funding the unfunded or funding the MSME sector, and which is the real backbone of our economy and which needs due support. So having said that, the challenge remains that unfortunately, whatever measures were announced resulted in liquidity coming to NBFCs for sure, but the liquidity was restricted to, I can use the word few in number, maybe hardly 10% in number of the large NBFCs which are highly rated. And that's because all these measures which were announced had three important factors which kind of were bottlenecks. First, of course, was the mode of lending to NBFCs. All these steps, TLTRO, Partial Credit Guarantee Scheme, Special Liquidity Scheme, they were all targeted at bank funding to NBFCs by investing in the bonds or NCDs issued by NBFCs. Let's appreciate that the small NBFCs do not access capital market because of the complexities in SEBI regulations. So they do not issue any bonds. For them, the mode of borrowing is simple term loans. The fact that term loans were not included in the scheme of things, that straight away ruled out these small NBFCs. Next issue was the tenure. All these schemes provided funding for a very, very short tenure of 3 months to 18 months. Whereas the need was to look at the fund requirement for on fresh lending. And that is where the funds are needed for at least 3 years to ensure there is no asset liability mismatch. The third key factor was the minimum prescribed credit rating as an eligibility criteria. Now we know, unfortunately, that the rating model or scale followed by the rating agencies is the same, whether you are a 5 lakh crore company or you are a 50 crore company or you're a 20 crore company. In such a scenario, getting the desired credit rating is a major challenge, almost impossible for small medium NBFCs. So these were some of the challenges. Now, fortunately, and I think we must compliment Governor RBI, the statement made by Governor RBI as part of the monetary policy announced few days back, that is 9th October, for the first time in history, RBI has come up with an on-tap TLTRO. That means asking banks to raise funds on tap. And further, they have removed these bottlenecks. So what they've done, RBI has permitted banks to use these funds to lend to NBFCs by term loans also. So term loans have now been included. Number two, RBI has not prescribed any minimum credit rating. So there is no prescribed level of credit rating required by banks when it comes to lending to NBFCs. So banks can look at even the underrated or the unrated NBFCs also. There is no bar. Thirdly, on the tenure, since term loans are included, obviously term loans will be for a tenure of 2 to 3 years or 4 years. So these bottlenecks have been very rightly, and I think this is something which has, I think, escaped the attention of media. And I would use this platform to highlight that there is a very loud and clear message coming from RBI to banks that please lend. I was reading somewhere that as recent as yesterday, banks had parked 5.5 lakh crores with RBI in the reverse repo. So still there is a huge quantum of liquidity surplus lying with banks, which is unutilized. I would appeal to my banker friends to please look at the small NBFCs, even the unrated ones, and give them term loans. Let them further on lend in the economy. It will be a win-win situation for everybody. Banks can earn a handsome spread because the money which they raise through TLTRO is at a repo rate of 4 or 4.25%. And when they lend to NBFCs, for the highest rated would be what, 7, 8, 9%. For even the smaller NBFCs, the rates can even go up to 12%. So there is a very handsome spread available for banks. It is a win-win situation because NBFCs will get the funds, and ultimately the borrower who needs that money will also get funded. So it is very important now. Now, having raised all these concerns, let me move to the way forward. As I said, NBFCs are bound to emerge from this pandemic as strong as ever. But there is a very important caveat and a rider here. As we are witnessing, one important issue that this pandemic has brought about is to look at more and more contactless operations, more and more digital operations. So the push or the message clear is to turn more and more digital. NBFCs, even the smaller ones, need to increase their digital footprint. That is a very key important factor. And in that, there are few elements which need to be, or the pillars which need to be kept in mind. Because why digital push? Digital push would give enhanced customer profiling, because you could do data analytics using artificial intelligence, blockchain technology. There are a lot of analytical tools are available in the market. A lot of fintech players today have developed some fantastic tools which can be used to do a customer profiling, and which will help you in sourcing customers for your lending business. Cost optimization, which is, I think, the crux of today's, not only for survival but growth. So cost optimization, which could involve process optimization, giving it more and more digital footprint. Workforce optimization. For once, I am not at all advocating issuing pink slips. What it means could be a readjustment, realigning their works, maybe in terms of geographies or in terms of the responsibilities which they handle. Third key important as part of cost optimization is fraud management. We all know with the growing digital push, there is also an increase in online frauds happening. We all know that. And I think that is where digital technology can help tackle frauds. Then, of course, is to make your collections smart. So this is part of the cost optimization. Then you could do employee reskilling. The employees need reskilling. They may not be so tech savvy. So you need to take this opportunity, use this opportunity to reskill your employees. So unless that digital push is given, I think it is a loud message for NBFCs, even the smaller ones, that going ahead post pandemic, if you want to continue to grow and grow at a healthy pace, please ensure sufficient increase in your digital footprint. For once, I am not at all an advocate for technology replacing human beings. No, especially in the lending business, because NBFCs have over the years succeeded in funding the unfunded because of that personal touch. So I am not at all saying take away that personal touch, but I am saying use technology as an enabler. Use it as an enabler to increase your efficacy, efficiency, transparency, and accountability. That can help you in your business a lot. Finally, there is also one important aspect I need to bring to focus, especially this being a very digital platform. Friends, we are witnessing a sudden spurt in what we call as online lenders, quote unquote. Now, this is a highly misleading term because we have seen mushrooming of online lenders across the country. And if you are aware, recently one of the leading business channels, TV channels, ran a whole series of program where they've highlighted on some of the most undesirable and unethical practices being followed by the so-called online lenders, where there were reports of data thefts because all their contacts from the mobile phones were taken away, and subsequent calls were made to all the contacts, their family members, and all sorts of unethical practices were used. So this has rung alarm bells amongst the regulator and policymaker. But what is important here is, as we have witnessed in the NBFC sector in 1990s, I think the same is repeating for the online lenders, because there are some excellent genuine online lenders doing wonderful business towards financial inclusion. So the need is to dive deep and ensure that we clearly demarcate the genuine online lenders who are registered as NBFCs with RBI. Similarly, there are genuine lenders who are acting as DSAs or sourcing agents for banks or NBFCs, and they are regulated under the outsourcing guidelines of RBI. From the others who are just individuals who just put together a platform and start lending 10, 15, 20,000 rupees, where the real concern is. So I think these factors need to be kept in mind. Finally, as I said, I think it's an excellent opportunity and I wish this summit all the best. I'm sure, once again reiterating, that being the Iron Man of the financial services sector, we will see a very strong, vibrant NBFCs emerging out of this pandemic. Thank you.
Thank you so much, Mr. Raman Agarwal, Co-Chairman of Finance Industry Development Council, FIDC, for an insightful and wonderful industry presentation. Now I request all of you to please join us in the launch of Banking and Finance Post magazine, the special issue on financial services and insurance. In this special issue, we have covered various aspects and various leaders of financial services and insurance sector. So I request all of you to please join us in this launch of Banking and Finance Post magazine special issue on financial services and insurance. Thank you everybody for joining us in the launch of special issue of Banking and Finance Post magazine, which is on financial services and insurance. And now we move on to the first panel discussion of the conference. On the topic, the 2021 outlook for NBFCs, significance, challenges, and opportunities. This important panel discussion will be participated by eminent panel. I would like to introduce you with them. First panelist is Mr. Abhijit Ghosh, Executive Director and Chief Executive Officer of UGrow Capital. Mr. Pawan K. Gupta, Chief Executive Officer of Muthoot Housing Finance. Mr. U. Balasundara Rao, Executive Director of Shriram Transport Finance. And Mr. Madhusudan Ekambaram, Chief Executive Officer of Credit B. And this panel discussion will be moderated by Mr. Arpit Gupta, who is Senior Assistant Editor of Elets Technomedia Private Limited. So I request Mr. Arpit to please take over from here and please start the panel discussion.
Hello everyone and welcome you all at the Financial Services and Insurance Virtual Summit. It's a two-day summit which is being organized by the Banking and Finance Post magazine in association with Elets Technomedia Private Limited. So on the first day of this virtual conference, we are at the first panel discussion, that is CEO's panel, and the topic of the panel discussion is the 2021 outlook for NBFCs, significance, challenges, and opportunities. And we have been joined by very renowned panelists from across the country. I'll introduce all the panelists here. So we have with us Mr. Abhijit Ghosh, he is Executive Director and CEO of UGrow Capital. Mr. Pawan K. Gupta, Chief Executive Officer of Muthoot Housing Finance. Mr. U. Balasundara Rao, Executive Director of Shriram Transport Finance Company Limited, and Mr. Madhusudan, Chief Executive Officer of Credit B. As the topic suggests, we are going to discuss about the significance, challenges, and opportunities for NBFC as the country is currently reeling under the crisis of COVID-19. So we'll take inputs of each of the panelists one by one. How are they looking at the challenges and opportunities? To begin with, I will request opening remark by Mr. Abhijit Ghosh. Over to you, sir.
Thank you, ELTS, for calling us, and really honored to be in such a company of such renowned names. Thank you for inviting me to be part of this team. As a professional, I think this event, we started looking at it as a black swan, but today, today the way I look at it, it is going to be pretty defining for financial industry, the way we have looked at the customers, the way we are going to look at the customers in the days to come, the way we have assessed the customer, the way we have onboarded and given, we are forced today to ask every basic questions to ourselves, and fundamentals are being relooked at. I think this event, hence, from a black swan, I think would be one of the biggest opportunity that NBFC as a sector would see. That's what I would say. Thank you.
Thank you. So now I'll go to Mr. Pawan K. Gupta for his remarks, his views about the NBFC's challenges and opportunities 2021.
Hi, good morning, everybody. I fully agree with what Abhijit said. Word by word, that is what is applicable to everybody. And of course, it would matter in which customer segment the NBFCs are operating. And so there would be a large thing, and then there would be a subset to it. So for example, we operate in affordable housing finance and particularly target the informal customers. So whatever points Abhijit mentioned, they are very much relevant for us. I would say these are the times which will make us much more stronger we will come out of it for sure. And the way we do business, many of the things which we thought we cannot live without it, now we realize that they are not so important. And many of the things which we thought were not so important, now we realize that they are important. So going ahead, I think the people who adapt and change to these changing environment and keep learning every day. I don't think that we have come out of the woods. It will be a long journey. And as we go along, we will have to be agile. We'll have to keep learning things and adapting and implementing. That is the way I look. So challenging but interesting times ahead.
Okay, first, very good afternoon once again. Thanks for having been invited for this panel discussion. And I represent Shyam Transfer Finance Company, which is into the truck financing. And first of all, let us understand what does an NBFC do. NBFC reaches a customer who is not serviced, who is under service, or who is unserviced by a banker. And be it NBFC or be it microfinance institute. I don't think there is a much difference between NBFC and microfinance institute. Both the entities serve the customers who are not serviced by a banker or who are not reached by a banker. Hence, NBFC and MFI industry is very, very important today because both of us are working to uplift the socio-economic status of a common man in this country. Otherwise, probably this common man cannot become an entrepreneur on his own without having been supported by a NBFC or by MFI. So NBFC and MFI is as much important as a bank in this country. So today, as Mr. Pawan has told, there are some challenges. There were challenges. In fact, the NBFCs and MFIs, if you see for the last 40 years or last 50 years, we have been seeing ups and downs. Ups and downs are not new to us. It's not that this code is, once the code ends, the downward trend is over or the problems are over. We might see another set of problems probably in the coming days, in the coming years. So we're going to witness more and more problems in the days ahead. And since having seen ups and downs the last 40-50 years, there are opportunities also ahead of us. There are plenty of opportunities awaiting us. So hence, let us think ahead. Let us grab the opportunities that are awaiting us, and let us do much more service to the community which is awaiting our services. I think these are what my opening comment all about. Then we can probably discuss in detail about the challenges that we have, or challenges we have, or the opportunities that are awaiting us. Thanks.
Sure. So yeah, thanks for the ELTS, the team to kind of invite me for this panel. And I couldn't agree more than what Abhijit and Bala and Pawan have spoken about. What are the current challenges, right? So just a brief about myself and what do I represent here is a quite different thing. We are a pure fintech player where so we use technology as a core to kind of lend. Unlike many of the other NBFC industry itself, like what Bala was saying, that it has seen many years, many ups and downs, and then many challenges. I think it's one of the biggest shock events what has happened to the fintech industry itself. I mean, the fintech industry is quite nascent. It all started probably in about 2016. We have not even completed about 5 years of a growth stage, and there were many concepts around or many apprehensions about the fintech lending, thinking whether it is a bubble to be bursted out, or is it just that whether there is a seriousness enough among the fintech players to sustain any shock, or are they serious about their collections in terms of the kind of asset quality what they are maintaining and whatnot. I think the answer lies with whenever the entire industry or the gambit of industry goes through such kind of a shock event, and how do they kind of survive such events, and then how do they kind of sustain their growth or sustain their existence and be part of this entire banking ecosystem, right? I think what has happened with this COVID entire situation is it has definitely kind of separated a lot of fintech players who had a lower asset qualities versus the guys who had a better asset qualities. That separated a lot of people with the major burning model what they were having in their entire the model of lending versus the guys who are very disciplined in terms of aligning to the principles of lending. I think there is a lot of differentiation what we could see, and end of it what we'll see is that some of the players who have survived this shock are going to be here for long. That's what I can basically kind of predict, that those are the guys who are going to be part of this banking ecosystem for a longer time than it is. But definitely the challenges and opportunities, as Bala mentioned, there are quite a few what we can discuss in length, not just to the NBFC world, and as well as what is very specific to the fintech world as well. Yeah, over to you, Arpit. I mean that's what is my opening comment, and we are happy to take your questions.
Thank you, Mr. Madhusudan, and all of you for your opening remarks and opening comments about what do you feel the future lies for NBFCs and what are the challenges and opportunities. So with this, I would like to ask some questions to all of you. Like, with the gradual easing up of the lockdown and COVID-19 situation, what challenges and opportunities are you witnessing, and how are you coping up with these challenges associated with liquidity? So I'll take opening remarks and comments for this question from Mr. Abhijit. Mr. Abhijit.
Sure. So I would interpret this question as a question that, how are you looking as a business continuity in this challenge, and how did we handle the COVID, and how did we utilize the situation? Is that a fair understanding of the question?
Correct.
Great. So, first of all, for us, we looked at health and safety of our employees, and we gave it a top priority. In fact, I remember around 18th or 19th of March, we were 100% operating from home. It was a very seamless transition that happened for us. Thankfully, we could do so without any hitch. The only thing that was continuing was the field collections, and that worked really good for us. Of course, post that, the business built up because we were also trying to understand what works, what doesn't work, how are the customers engaging, how was the various feedbacks, because we ensured at least once a month we touched base with 100% of our customers and worked out probable scenarios that could happen, and we were constantly engaged with them. Third thing that we did was, these were tough times. What we did was, during this time, when between March to June, I would say, we pretty much all while working from home, we further worked on our fintech activities. For example, today we have a fairly decent underwriting algorithm built on predictive cash flows on the SME lending space. We have digitized and digitalized all physical process today. We are 100% contactless, except what government doesn't allow. Right? But otherwise, our 100% processes are contactless, and we do up to 3 crore loans on the secured side as well. So we're talking decent working capital lending there. One more thing which did was we relooked at our distribution strategy, and we are making our presence more stronger in a few of the target geographies. So I think it's been a good time for self-look, improve on what worked for us, further reinforce that, and come out with a better program. So already we've come out with a program called Sanjeevani, which is a 100% contactless loan program. We are coming out with one more program in the next 2 to 3 weeks. So it's been a pretty good time for us. Thank you.
Thank you. Thank you, Mr. Ghosh. Mr. Pawan Gupta, you represent one of the most important sectors which is being looked at as a catalyst to revive the economy, that is housing sector. Government is also giving a lot of push. So what are your views? How did you manage the challenges, and what opportunities are you witnessing after this unlock?
Yeah, Arpit, you are right. Housing has always been a very important aspect from the government perspective, because It contributes significantly to the GDP, and it is a big multiplier, close to 252 industries directly and indirectly linked to the housing. Apart from that, as I mentioned, the target segment which we cater to, they are the ones who are really deprived of having a home. So it's a dream for them to have a home. So what Abhijit said, more or less on the same line. However, in our business, the physical touch was very, very high, because these customers did not have any income documents. So most of the assessment of the income used to happen basis the personal discussion and visit to the business premises. And being long-term loan, we need to evaluate a little differently versus, because these are 15, 20 years loan. And when it comes to legal verification, technical verification, these all things involve physical touch points. And obviously collection, we have this electronic mode of payment through NACH, but whenever the customer bounces, we have to reach out to them. So the first 1 month was a complete lockdown, and of course, I would not say 1 month, 2.5 months. Subsequently, things started to open up. So in the month of April, I would say, as far as we are concerned, business or collection had come to a complete standstill. Of course, we were being in touch with our customers on over telephone, etc., so that we keep them engaged, we understand what's going on. And as things started to get little relaxed, we started coming back. The first focus was on collections, right? Business was not a priority because the businesses were not open for me, large number of customers. So focus being collection, and as things started improving, we started doing the partial disbursement of the customer who had already availed the loan, and then we started the new disbursement. So as I mentioned earlier, we learned a lot. Many of the things which looked impossible started becoming possible, and vice versa. And as I said, not only from an organizational, from a personal perspective also, I think these will be the great learnings. And I pray to God that such opportunities do not come again, right? Let these learnings be learnings for us to implement in a better way going ahead. Opportunities, I see a lot of opportunities, because there will be a pent-up demand, and with the focus of the government on housing always being there, and more so in the EWS and LIG segment, I see great amount of opportunities. These are the segment who are coming back very fast, because small businesses don't take much time to restart their business, right? And they are also very versatile. If something is not working, they move on to something else. Let us say somebody was running a small vada pav shop, and he see, okay, nobody is buying vada pav, he started selling vegetables, because that was selling at that point of time. So our customers are very adaptable from that perspective. So I see good opportunities in the days ahead. We are becoming more and more digital. It takes some time for us to completely digitize our processes because of various things which come on our way. But yes, as we move along, we will move more and more towards contactless thing in the days ahead.
Thank you, Mr. Gupta. Mr. U. Balasundara Rao, transport is one of the most affected sectors in these days. Credit goes to COVID-19. And what challenges did you face, and what are the opportunities you are witnessing in the future?
Yeah.
And how are you coping up with these challenges?
Okay. Probably, I think I got to tell you something about the Insurance Transfer Finance Company, because we are in the business of financing user vehicles for last 30-40 years. We are in this business for last 4 decades. In fact, if you look at our book now, we finance more user vehicles rather than new vehicles. And the book size is almost about 1,10,000 crores of assets under management we have today. And maybe about 8 to 9% of the book is for new vehicles, and balance 92% is only for old vehicles. We finance majorly for used vehicles. And we finance only small road operators. A small road operator is, by definition, is an operator who doesn't own more than 5 vehicles. We do not finance any fleet operators because fleet owners get loans from anywhere in the country at a better rate. But a small operator who doesn't have more than 1 vehicle or more than 2 vehicles, he doesn't get a loan from a formal banking system or formal credit system at a affordable rate of interest. And he is our customer. And we've been financing this customer for the last 40 years. And we will continue to finance this customer for the days to come in. And as we had some challenges, it is not that we did not have challenges, we had some challenges right from the lockdown was announced. And initially, probably for about a month or so, the vehicles which were carrying only essential goods flying on the roads for about a month or so. And there was a national lockdown, there were state lockdowns, there were lockdowns observed in districts, in talukas, and mandals. The entire supply chain got disrupted for about a month or so. And as I said, the vehicles which were carrying only essential goods flying on the road, the vehicles which were carrying non-essential goods were not allowed to fly on the roads. That was the scenario for about a month or so. Then gradually things started getting eased out. Then every vehicle today is flying on the roads. And one of the best indicators for us today is the fuel consumption. We are closely working with HPCL, we are also working with the BPCL, and we are also equally working with IOCL. And in fact, we give credit to our customers for fuel consumption. So we also get to know how is the fuel consumed by our customers on day-to-day basis. Today, we understand that the petrol consumption has almost reached pre-COVID levels. And fuel, as far as the diesel is concerned, the diesel consumption has almost reached 93-94% of the pre-COVID level. So which means that most of the vehicles are today flying. Only vehicles which are meant for carrying passengers, be it an aggregator, Ola, Uber, or the tours and travels, or the school buses, or the buses which are meant for carrying staff to offices. This segment got affected a bit. And probably there is going to be pain for some more months, probably another 3-4 months. Otherwise, all goods carrying vehicles have started flying on the roads. Today, I was just going through the statistics today morning. The e-way billing was up during September month. It is almost, I think, 10% up year on year during the month of September. And the e-toll collection was almost 2,000 crores in September month. That was almost 5% up over February 2020 figure, which means that things are back to normalcy. And initially, a lot of companies have given moratorium, on the directions of RBI. We also gave moratorium to most of the customers. To about 90% of the customers who gave moratorium for payment of their installments and interest for about 6 months' time, right from March 2020 to August 2020. But also, we are able to effectively communicate to the customers that the moratorium is not interest-free. This moratorium carries interest. At what rate? At the contract rate, at the rate at which the contract was signed up between the company and the customer. When the customers got to know that this moratorium is not interest-free, gradually people started paying the installments. If not full, but part of the amounts were paid by the customers. April month was a tough month because there was uncertainty. People did not know how long this lockdown is going to continue. And people did not know whether the vehicles are going to be plied or not plied. People are not sure about the future. So they are not parting, they are not willing to part with their money. Even then, we were able to collect at least from 40% of the customers during the month of April. And May it went up to 50%, June it went up to 60%. In fact, September we were almost able to collect from 94% of the customers. This 6% is only the passenger commercial vehicles which were financed, be it Ola vehicle, be it Uber vehicle, be it a school bus, or be it a bus which is carrying staff to the office. Challenges, I think, almost are over today. In fact, if you look at the car sales is picking up, two-wheeler sales is picking up, LCV sale is picking up, tractor sale has almost increased by almost 15-20% over previous months, of last year. So we're able to see green shoots in the economy. Challenges were there, challenges I think probably, as I said, the other economic activities will have to be opened up. Probably cement, your industrial activity is gradually picking up. I think once the industrial activity starts picking up more and more in the coming days, then all our vehicles will be on the roads. And today, most of the vehicles are on the road. And probably today, there is a small issue with the freight rate and the load. I think once the industrial activity is completely opened up, I think then we are back to normalcy completely. We had challenges earlier, as I said, but if the government is going to spend more money on the infra, and if the industrial activity is going to pick up more and more in the coming days, then I think we are back to normalcy. Today, the best thing is that monsoon has been good. The rural economy is looking up very good. And I think we're able to, we'll be able to come back to normalcy very soon. Almost we're back to normalcy. I think we'll be able to come back to normalcy very soon. I think that's all. I think.
Thank you, Mr. Rao. And you talked about a very important topic, that is moratorium, which we will discuss in the later part of the session today. But before this, I would like to ask my previous question to Mr. Madhusudan. Sir, your views about the challenges and opportunities. How did you tackle the challenges in your organization, and what opportunities do you see in the future?
Probably I'm trying to answer not just on behalf of TradeB, but on behalf of the fintech industry or the digital lending fraternity, right? So I think the challenges and opportunities, as we heard from other lenders, right, other lending industries, I think are very specific to different industries. Right? The key idea for any company was what I feel was to adapt and innovate. Right? Just to give you a vague example, right? So, for example, what we saw is that the e-commerce companies started selling groceries, fruits, and vegetables and whatnot. Right? So I think the sense went into even to that extent of trying to kind of the adapt and innovate. Right? So having said that, let's look at the broader aspect of challenges what the fintech industry faced, and how some of the measures what we took to kind of in trying to face these challenges. One biggest thing what affected everyone is the cash flow. Right, so we saw many examples, like starting from some car makers started making some manufacturing the ventilators, to winemakers started manufacturing hand sanitizers. So many companies tried to innovate to keep the cash flows intact, especially in the fintech industry. So what I would say is that what we did, first of all, let me give a brief background, and before answering that, is that we did not see the effect of moratorium to the extent what the traditional lending industry saw to that extent, right? So just to give you an idea, that the personal loan segment or the unsecured loan lending, what digital lenders were doing it, the collection efficiency was always over 60%, even at the industry level, right? So there was only about this 40% of the book which was, or the customers who are not paying back, even in the months of April and May as well, right? So for us, that particular thing was the collection efficiency was almost like a 75%. Today we are somewhere at what we see is that as most of them mentioned, I think that there's a good revival of this particular payment behavior, and where we are seeing almost like 96-97% of our collection efficiencies what we are able to kind of reach in the months of like September and October. Now, what I see with this particular thing is that there are two concepts. One is the new business which got restarted. We all started lending within the fintech world from the month of August, September timelines. So there is a new book which has kind of started lending, and then there is an old book which remained with us just before the day of lockdown, because we stopped businesses and whatnot. And also there is a typical difference from the traditional NBFC segments is that the tenure on this particular fintech lending is almost averaging at about like 6 months. So we don't have most of our books carried for more than a year or so. So the books got depleted. That was the thing that happened. So there was good amount of cash flow that was happening, considering that the collection efficiencies were good. But what we face as a challenge now is to kind of rebuild our book to ensure that there is a certain AUM that kind of is managed to keep the health of the company going. Right? I think that's one challenge what we are trying to kind of address. I think definitely, being in the fintech world, there is a bunch of investors who kind of aggressively invest in the fintech companies. So definitely the growth has taken a setback. I mean, there's nothing known, whatever the new product launches or the revenue targets or anything, all these things have kind of definitely taken a setback. And definitely there has been kind of understood by many of the stakeholders as well. I think being resilient in such times and not trying to be tomboyish made a lot of sense. So now the new thing what we are looking at is that when will we achieve this particular business what we used to have in, let's say, Jan-Feb timelines of 2020? When are we going to kind of bounce back to that kind of a business line, that kind of a business levels, right? So for some people, it's about 6 months timeline from now on. Like by March 21, they want to kind of revive their business back to like Jan-Feb numbers, or for some other people, it may go as high as 2 years. So in the fintech industry, what I'm seeing is anywhere between 6 months to 12 months is what everyone is targeting from here on to kind of bounce that back to the original levels, right? So that's some of the challenges, largely what fintechs are going through. Of course, so there's a lot of fintechs have had to shut their shops down and as well. But the biggest opportunity what we see is that the technology will be the enable for various services where manual interactions were inevitable, right? So in fintech lending world, the borrowers are almost like totally have moved towards paperless or contactless processes, which helps solve the very cause that fintechs were trying to achieve. So we want to kind of be the enabler. We have a lot of technologies what we have done for your KYCs or your e-contractual agreements, which can be signed contractually. There are a lot of fraud detection in terms of your face liveness or face recognitions, face matches, and a lot of fraud technologies what we have developed, which was very much necessary for the fintech world. And we want to kind of enable the rest of the MFI industry or the NBFC industry to use these kind of technologies to kind of cope up with the current situation where most of us are moving towards kind of a paperless or a touchless kind of a banking. Yeah, I think that's the larger opportunity kind of what I basically see here.
Thank you, Mr. Madhusudan. We'll come back to technology, and yes, technology is an enabler, and it is playing a very important role nowadays in the fintech industry. So that we'll cover during the later part of the session. But as I previously said, that moratorium, which was introduced in the wake of the economic devastation, which was caused by the pandemic COVID-19, has come to the fore, and now the government is also proposing to waive of compound interest, the interest on interest charges. So I would like to understand views from the industry stalwarts, if you are sitting all up here. What are your views pertaining to the moratorium? Mr. Ghosh, I'm coming to you.
Okay. So, first of all, regulatorily, there has been a lot of, this is the first time when smaller NBFCs, larger NBFCs like Shriram and all of that, were looked differently, right? So that was the first time that we saw. And that was a pretty pragmatic approach that we saw from the government. The second thing that we saw was the special borrowing window, which was opened for special purpose, on a stressed customer. That again was a big thing that we saw. So these are 2-3 large things. Whether it is TLTRO2 or PCG2 or the entire economic package which the government gave, all of that was a great one, right? Having said that, I feel that few things should be looked at, and so, for example, the regulator could consider extending the funds through the SLR route maintained by the larger NBFCs back to the smaller NBFCs, because today the liquidity has become or is becoming a challenge for especially startups like us who are professionally led and do not have a large number of years of backing, of being in the industry for their, or not being promoted by large brands. So companies like us would for sure need that. Smaller NBFCs also need such things. Fintech for sure needs such backing. The second thing that we see is that can there be a liquidity adjustment facility be allowed by the government, as collateral, or can the public deposits held by the most NBFCs even though it is limited, can that be used in certain way? Because the liquidity needs to go up, or a little push by the bank by doling out some thing. Because today what they are limiting is only up to 20 lakhs. And there are various kinds of NBFCs who have found their own spaces beyond 20 lakhs also. Can there be some kind of nudge which can be given to the banks to look at that? Because we are again seeing some amount of drying down of NBFCs happening. Even though for a company like us, which is well capitalized, and we carry almost a substantial amount of liability on a free cash level at our book. So it is a little different for us. But I think if I speak about the larger industry, I'm sure there can be some liquidity measures to continue what they had done immediately the moment the first or the second pandemic various government announcement happened on the liability side.
Mr. Pawan K. Gupta, your views.
So, as far as monitoring is concerned, I divide this into two parts. One is that it was absolutely essential because everything had come to a standstill. If you talk about a retail customer, of course, his cash flows were stopped, or his shop or offices were stopped. Similarly, for the finance companies, the inflow of the money which was lent, that had come reduced significantly. So it was a necessary thing, and I think that was the step done. The second part is the moratorium to the companies, the lending companies like us. Of course, there was a lot of confusion in the beginning. As Abhijit said, we were fortunate. We belong to a large group, so we did not face much of these challenges on the liquidity side, right? But what we have seen is banks were not they were not keen to lend. Even if you see today, it's more of the funding coming from the TLTRO or special refinance scheme, etc., etc. So the actual lending banks used to do, that is still not happening. And even if they are doing, the terms and conditions are much tighter. The rates came down significantly, but some of the banks increased their spread, citing whatever reasons, and you don't stand a chance to argue with them, right? So I would say that the retail customer were at an advantage, but when you factor in companies and corporates, I think it was needed, but total benefit did not come to us. And again, of course, the rating agencies it was told to them that this should not be factored in, but I'm sure in their calculations going ahead, they will factor in which companies have availed, which have not availed. So it's a very tricky situation from that perspective. Liquidity for big companies or well-capitalized companies or big groups, I don't think there is much of an issue. But for smaller companies, startup companies, or I don't think things have changed very significantly. So the liquidity support was never required by the big companies or big corporates. It was always required by the small and medium ones. And I think that need to continue for quite some time, at least for the next 6 months.
That is what Mr. Ghosh was also pointing out, that there should be some support by the regulator to the lending agencies, and there should be proper monitoring and vigilance over the overall activity which is being executed for this moratorium. I'll go to Mr. U. Balasundara Rao for his comments over.
What is happening is they are very reluctant, they are very risk averse, right? So even if they are giving some incremental lending, they are swapping it with the ones, right? So they give some fund in limit, they say close that one and you take it here. So effectively, there is not much of support coming from the banks for a large number of companies. Yeah, please go ahead.
Yes. So I take quick comments from Mr. U. Balasundara Rao. Over to you, sir.
Moratorium for payment of installments or the interest was a necessity when the lockdown was announced, because we all knew that the business is not going to be the same as earlier. And initially, government thought, or rather RBI thought, that this pandemic is coming to an end probably next 2 months' time or 3 months' time. Hence, they've announced a moratorium for 3 months, for the month of March, April, May, and all. Then somewhere in the month of May, they realized that this pandemic is not going to come down for 3 more months. So they've extended it. Probably it was a necessity. But at the same time, the moratorium for payment of installments for the NBFCs and the companies was not given by bankers, which have lent to them. Today, the NBFCs or MFIs or the so-called startups and the companies, they give the moratorium for payment of installments to their borrowers. Okay, there are 2 schemes. One is opt-in, second is opt-out. Different companies and different banks have taken different stands. Some companies and some banks have taken a stand of opt-in. The borrower himself has to write a mail, or he has to tell the banker that I want a moratorium for 3 months or 4 months or 5 months. Then the moratorium is given by the bank to the borrower. Another model is opt-out. Companies and banks are giving the moratorium to all the borrowers across the board, and the borrower has to himself opt out of the moratorium scheme. So 2 schemes are there, and different companies and different banks have followed different schemes, and we have followed the second method, opt-out. We gave moratorium to all the borrowers for 6 months. But we have conveyed to the customer this moratorium is not interest-free. Please remember, as soon as the moratorium comes to an end, you got to pay interest for 6 months at the same rate at which the contract was executed between both of us. We're not going to collect interest from you as soon as the moratorium comes to an end. No, this interest will be spread across probably for next 6 months or 7 months or 8 months or 9 months, whatever. So the instant amount will go up after the moratorium comes to an end. Or if you want to keep the same instant amount, the tenure goes up. These 2 things we have effectively communicated to the customers. And having realized that this moratorium is not interest-free, as I said earlier, many of the customers have started paying their installments. Part amount, if not full amount. Hence, the strike means the percentage of customers from whom we have collected installments, it went up month on month. It was 40 in April, then it went up to 50, then it went up to 60, it went up to 80 in August, and almost I think we're at 94% in September month. However, there is no moratorium for September month. Moratorium was a necessity, but at the same time, RBI should have ensured that the banks which have lent money to NBFCs and MFIs also given moratorium to these institutes. Then again, I think the issue was taken up by Government of India and RBI. Again, they had a meeting with the bankers, and the bankers have said that we will give moratorium on case-to-case basis. That is the stand they've taken. Fine. Now moratorium has come to an end. Now you're also talking about interest on interest. I tell you a small example. When a depositor is invested with me a lakh of rupees, he has an option of taking interest on monthly basis, or he has an option of taking interest at the end of the deposit period. If a depositor wants to take monthly interest, he has an option of taking monthly interest. But suppose if a depositor wants to take interest at the end of the tenure, 3 years or 4 years or 5 years, we got to give interest on interest. That is a fundamental concept of, lending. He has lent money to us. And similarly, if a finance company lends to a customer, and if the customer is not paying interest for 3 months or 4 months or 5 months, interest on interest is applicable. That is a fundamental concept. But today, Government of India says that, they can probably waive off, and they will compensate the lenders for the loss that they're going to have for the 6 months or 5 months, whatever. But you got to see the modalities how the Government of India is going to compensate the lenders interest loss that they're going to incur for the past 6 months. And it is subsidies. We will not comment as of now, and we are awaiting the modalities. That are going to be framed by Government of India, how they are going to compensate us for the interest loss that we are going to have during the moratorium period. And as far as the liquidity is concerned, thankfully our collections have been good during the moratorium period. At the same time, we got some benefit from the TLTRO2 as well as the partial credit guarantee scheme announced by the RBI. If not from the special liquidity scheme, but we have got some support from TLTRO2 as well as partial credit guarantee scheme. And our collections have been robust even during the mountain period. Hence, we were able to, we were able to survive and we could come out of these blows. And now I think we are pretty good. We are able to raise a lot of money from the banks, and we are able to securitize our portfolio with a few institutes like Elets India and all. And somebody has said the cost of funds has actually for us it has come down, but there is a risk of keeping the money with the banks. Under this uncertain during this uncertain time, that is costing us actually. Actually, the cost of money in raising the resources actually for us it has gone down by 50 basis points. But the cost of keeping the money in the bank account that is costing us more than anything else. Otherwise, I think we're liquidity-wise, I think we are quite comfortable so far. In fact, we have liquidity to meet our liabilities probably for next 6 months. That is the scenario that we are into. Yeah.
Thank you, Mr. Rao. I'll just take quick views from Mr. Madhusudan because we are almost at the end of the discussion. So after this input, we'll go for quick inputs from all of you on my last question. Over to you, Mr. Madhusudan.
Yeah. Let me keep it short because my views doesn't really differ from a lot of the things already being discussed here. The one thing which quickly I want from even the regulator and what's happening with this moratorium is somewhere this should stop surprising us. So every time it comes as a lot of surprise to us. Be it the moratorium 1.2, 2.2. Of course, it's a necessity. I don't deny with that. And the recent Supreme Court hearing on interest on interest. So somewhere all these surprises have to kind of stop. I think that's the biggest support what we would want from the regulator. So it's not that we can keep taking the beating one after the other and then keep trying to kind of adapt and keep kind of adapting to the new policies, what is going to come out and stuff like that, right? So I think that's one big thing. What we expect is some kind of a stability that coming into any more policy changes, which should not kind of adversely affect the lenders, or it should not kind of keep surprising us every other day. And most of it for us comes on a newspaper, right? So every day it also sometimes it becomes nightmarish if my CFO calls me someday at the early morning and says that there is a new policy that has come out here, right? So I think that is one thing. The second thing is somewhere as it was being touched upon that larger companies didn't kind of really face the liquidity problems, but wherever the mid-sized and the small-sized NBFCs, I think the entire package is not really reached out to these guys. Somewhere it's a very revolutionary thought that whether instead of keeping the banks as an interface to offer these relief funds or these relief packages to the mid-sized or small-sized companies, could have RBI or government directly done that. So that the intent was very clear that they wanted to help with TLTRO2. I think the intent was very clear that there were specific targets for the banks to lend to the mid and the small-sized companies or the NBFCs, but banks showed little or no appetite towards some kind of a fresh exposure to the risky assets, whatever they call, right? So I think whether the government or RBI could have taken the matter into their own hands in trying to kind of provide these kind of packages directly to the companies would have been helpful. And second thing is definitely they should start surprising or giving any more surprises to the lenders and focus on keeping the policies very stable, and that would help the companies to kind of restructure themselves or adapt themselves in these scenarios. Yeah.
Yes, Mr. Madhusudan. You rightly said, and I'm now coming to the last question and a very important point of this topic today. Mr. Ghosh, NBFCs are looked as the key pillar of the 5 trillion USD economy, which is being proposed by our Honorable Prime Minister Narendra Modi ji. A lot of things have happened over the past 6-7 months. But what is the reviving strategy? What practices from the lockdown period would you like to continue post-COVID? And what are the innovations would you like to adopt for the next financial year to revive the overall efficiency? Over to you.
Sure. So first of all, look, Deloitte came up with a study where very clearly it is showing that 72% of the customers are exhibiting a clear preference for transactions on digital mode, right? So that's a very good thing. This came out in this pandemic thing, which means that the entire journey of the customer today can be 100% digital, right? So that's one good thing that came out of this. Second point is the start of account aggregator. We personally feel, especially the credit staff or the non-credit or a customer without a bureau history, that can really get a great support today because of the account aggregator as a concept. And third one, I would say that each of us as a company today have done various things. So we were lucky to be well capitalized, and in spite of we being a startup, we got a lot of debt during this program. We were also lucky to have signed up with 4 banks for co-lending program. So all of that helped us. But in general, what we also did was we completely used all these learnings and went completely digital. We're seeing a lot of customer acceptance, and in lending, as I was talking at the start of the conversation itself, the collection efficiency today, how we stack up, is the final proof of what kind of lending we have done in the past, right? And whatever we have seen, basis our September result, too early to comment, or the performance during the pandemic time, the collection efficiency, I think we've done substantially well than many of the established peers of ours in the industry. Our collection efficiencies are close to double digit above the kind of similar companies in the market. So it's stacking up well. We would want to use this learning to do it, further expand. And that's where I started with the opening comment that, we see this as a great learning thing. And this Black Swan event will be the biggest game changer for companies like us in the days to come. Thank you.
Thank you. Thank you, Mr. Ghosh. Mr. Pawan Gupta, your closing remark.
I would say that these were unprecedented times, and they are not yet over. The thing which looks is that things will get much better, much faster than what we thought in the month of April and May. Things never turned out to be so bad, or things never turned out to be so good. Whenever we keep thinking about such things, so there will always be a mid path. So I feel things are getting better, and hopefully by March, whether COVID is there or not there, people have moved on in life. We will all have to adapt to it, even with vaccine, without vaccine, whatever it is, right? And that is what we see today on the ground, we see on the streets. Economy should come back to track. However, as we discussed throughout the discussion, that a lot of things will change, the way of doing things, the way of picking up customers, the way of servicing the customer, the way of underwriting a customer. Technology would play a significant part. We see TCS and Infosys share going up like anything. I'm sure that is a clear indication that big or small, everybody will be more and more moving towards digitalization. So every challenge gives a lot of opportunity and learning, and that is what we have learned, and we'll keep learning.
Yes, that is the key. Learning is a continuous process, and like it is said, every crisis is an opportunity. So probably this has also opened a door of opportunities for all of us. I'll ask the same thing and closing remark by Mr. U. Balasundara Rao. Over to you, sir.
Yeah. So I think digital is only the because ours is a cash and carry business. Customers carry cash, and the customers remit cash as their instruments. In fact, about 20 years ago, we used to collect almost 80% of our collection only in the form of cash. About 15, 20 years ago, I'm talking about. But today, our cash component has come down to 40%. And during the monitoring period or during the locking period, when the lockdown was observed during the month of April and May, whatever collections that we could make, majority of the collections came only through digital mode. Because during the month of April, our people are not, able to meet the customers in person. But most of the relationship managers and most of the relationship executives were in touch with the customers over phone. And they have inculcated a habit of transferring the money through digital mode among our customers. And gradually the unlocking has started, from May month. And again, our people have started moving in the marketplace, and our people have again started meeting the customers in person. Again, the cash component has started increasing. Whatever habits that the customers have inculcated in the month of April or May, they gradually started vanishing. Again, people started observing, again, people got back into the old habit. I think whatever we were learned during these initial periods, I think we got to work on it. And today our cash component is almost 40%, 30 to 40% of the total collections. That we need to bring it down over a period of time. And the best thing is that the profile of the customer is undergoing a change in the business. Today, the customer is becoming younger and younger in the transport business. So they're becoming tech savvy. So it is easy for us to habituate them into the digital mode. So that's what I think we got to do it. And second thing is that we also keep funding the working capital loans for the business of the customers. For any loan that the customer takes, many of the times he has to come in person to office, or our people have to go to the customer's place in person and get the documents signed. Gradually, we're also moving into the digital mode, e-agreement kind of a transaction for getting the signatures of the customers and getting these agreements signed between both of us. I think these are learning that we have learned. These are all the lessons that we have learned during the initial stages of COVID. And these learnings, I think we'll try to take them forward and becoming, we will try to become more digital and more tech-savvy company in the days to come. Thanks.
Thank you, Mr. Rao. Quick comments from Mr. Madhusudan.
Sure, I think
last 1 minute.
Yeah, definitely. I think it's very interesting to know that everyone has kind of has taken one specific idea about technology and digital being the way forward. I think that's a lot validation for the entire fintech industry, where the core at which we started our journey was technology, right? So I think that's one good thing that has come out for all of us. Now, while we have spoken a lot about the customer journeys and how technology is changing and everything. So what we should not forget is the other things that are happening within the company, especially how technology has gone into remote working, right? So most of the guys are kind of doing remote working is going to be part of many of the companies moving forward. Not just the lending industry, but every other industry, right? So, and then expanded use of technology to monitor the employees, So we have a lot of people on the field, be it the collection agents or the sales agents and whatnot. So I think there is going to be a much more larger scope of areas where technology can really kind of help in these scenarios, and not just the customer journey, but in terms of, as I talked about, be it remote working or kind of monitoring the employees, right? So virtual meetings have become too much of a norm. And one last comment, what I basically would like to say is that I think we all have gotten into the habit of eating healthy, so we are not eating outside is what has helped us to kind of regain back our health. I think those are some of the bright points, what we have really seen due to this COVID. We are very hopeful that all the lending industry will be reviving back. There is definitely some losses what everyone is going to incur because of this 6 months or 7 months of this lockdowns and whatnot, but more so we are looking at regaining from that loss and then moving towards with our normalcy in the next financial year. I think that is also kind of resonating from all of us. Yeah.
And I think that is the new normal, what we are saying these days. So thank you. With this, I would like to thank all the panelists for sharing your expertise and your views about the topic, the 2021 outlook for NBFCs, significance, challenges, and opportunities. I would like to thank Mr. Abhijit Ghosh, Executive Director and CEO of Grow Capital, Mr. Pawan K. Gupta, Chief Executive Officer, Muthoot Housing Finance, Mr. U. Balasundara Rao, Executive Director, Sri Ram Transport Finance Company Limited, and Mr. Madhusudan, Chief Executive Officer of Credit Bureau. With this, I would like to thank all of you and looking forward to seeing you again in our conferences. Thank you.
Thank you.
Thank you very much, the eminent panelists. It was really an insightful discussion. And thank you, Arpit Gupta, for a wonderful moderation. And with that, we close this panel discussion here and we break for a networking break. I would request all the delegates and all the speakers also to kindly visit the expo in the sidelines of this conference. And let's meet after this short break with the next panel discussion. Thank you.
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by sensitive data. You can then apply data-centric protection, such as encryption, granular access controls, and tokenization. For encryption and tokenization to successfully secure sensitive data, the cryptographic keys themselves must be secured, managed, and controlled by your organization. Finally, virtually every data security regulation and mandate requires organizations to be able to monitor, detect, control, and report on authorized and unauthorized access to data and encryption keys. The CipherTrust Data Security Platform is an integrated suite of data-centric security products and solutions that unify data discovery, protection, and control in one solution. Thales has pushed the innovation envelope to remove complexity from deploying data security, accelerate time to compliance, and secure cloud migrations. The platform provides powerful tools to discover and classify the data that your organization should be protecting, protect against external threats and insider abuse with robust encryption, granular access controls, and tokenization strategies. Control your data wherever it is stored with strong centralized key management. The many solutions available on the CipherTrust Data Security Platform can be deployed individually or in combination, so you can secure your organization's most sensitive data without increasing deployment and operations complexity. This results in less resources dedicated to data security operations, ubiquitous compliance controls, and significantly less risk across your business. You can rely on Thales to help you discover, protect, and control your organization's most sensitive data, wherever it resides. To learn more, visit Thales' CipherTrust Data Security Platform.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना रुतबा प्राप्त किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं। और ये मेरा साथ मैं हमेशा कहता आया हूँ, आईटी प्लस आईटी इज इक्वल टू आईटी। इंफॉर्मेशन टेक्नोलॉजी प्लस इंडियन टैलेंट इज इक्वल टू इंडिया टुमारो।
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection regulations, and aren't addressing new hacker tactics, leaving organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by an overburdened staff will never meet today's compliance and security challenges. An easier and unified approach to discover, protect, and control sensitive data everywhere is the only.
Welcome back after a short break. Now we will be moving on to the next panel discussion of the day. And this discussion will be on a very important topic, which is the shift to digital transformation and expanding role of digitization in NBFCs. I would like to introduce the panelists to all of you. Mr. Joby CEO, Chief Executive Officer of Dwara KGFS. Dr. N. Ramendran, Chief Information Officer of Shakti Finance. Ms. Jizi Omen, Chief Technology Officer of Kenara Capital. And Mr. Ashish Tekekara, Head of FI, Origination and Digital Business in Northern Arc Capital. And the moderator for this panel discussion is Mr. Anand Sharma, Chief Technology Officer of Ashirwad Microfinance Limited. So here, I would like to request Mr. Anand Sharma to please take over and start this very important and wonderful panel discussion. Mr. Anand Sharma, please.
So good afternoon, everyone, and thanks to Elets Technomedia for organizing this webinar. Though we are into October, but we have a very August panel. And today's topic is the shift to digital transformation and expanding role of digitization in NBFCs. And we have a very seasoned and experienced panelist over there. I would like to introduce them one by one. We have Gigi Omen. Gigi Omen is a business-minded tech leader with over 22 years of experience in financial services and entertainment industry. As of now, she is CTO of Kinara Capital, and prior to Kinara Capital, she was associated with Manapuram and companies like Bajaj Capital. We have Joby CEO. Joby is a very well known in the microfinance industry and financial inclusion. And over the period of 18 to 20 years, I think that he has not only built, transformed, and led very fortune microfinance and financial inclusion industry. So at present, he is CEO of Dwara Kshetriya Gramin Financial Services. Prior to that, he was with Varam Capital, IFMR, and ICICI Bank. We also have Dr. Ravindran, a well-known personality from Tamil Nadu, Group CIO of Shakti Finance Limited, and he has expertised himself over the period of time into enterprise-wide solutions, because everybody who knows about Shakti Finance, they are into multiple dimension businesses. Process automation and digitization is his forte. And then we have a very young talent, Ashish, with over 10 years of experience. And I was very impressed to see his profile. I am just gone through his profile on LinkedIn. So right from the beginning, he has been associated with Northern Arc Capital. And he possesses a very unique skills which we normally do not have, whether it is deal sourcing, due diligence, credit underwriting, portfolio management, and risk management. So over the period of 10-12 years, he has actually masters all these things. And myself, Anand Sharma, CTO of Ashirwad Microfinance Limited. So since we have a very good mix of panelists, and we will share our knowledge, and I would like to start with Joby, because Joby is the man who builds the organization, he transforms, and he leads. So over the period of 20 years or so, Joby, how you have seen businesses getting transformed using technology, especially digitization? What does it mean to you?
Yeah, no, so thank you, Anand. Very proud to be on this panel, and thanks a lot for your great introduction. I've been in this whole, kind of financial inclusion space for a long period. I've seen the whole transformation right from, kind of early 90s, the way it's been kind of coming into shape. And had the opportunity to kind of see some of the kind of real transformations happening around the world as part of ICICI, kind of being fortunate to kind of travel around the world, the way microfinance and the small business loans are being kind of done around the world. And then, kind of could come back and along with Nachiket could set up IFMR Trust way back in 2010, and been kind of then part of the IFMR Capital, which then now became the Northern Arc. So over the years, I've seen microfinance kind of really hitting scale, and kind of the whole process-driven, very rigorous approach because customization was very difficult, right? I mean, you just want to kind of take from the menu and offer it, therefore you can hit a very huge scale. And we saw that, right? I mean, from one cycle to another cycle, and kind of very standard groups, no confusions to a customers who are not very educated, very simple communications, and it kind of really grew. But it had its own difficulties because not everybody needed, the same loan product everywhere. But that's good what the industry could kind of really provide. And for me, the real moment of transformation came when I been fortunate to kind of partner with a promoter group here to set up Varam Capital. And I thought, around 2013, 14, I thought the time has come, kind of we can a bit reimagine microfinance in a new way. I thought when 25 years back, when Mohammed Yunus kind of really thought about this, the whole context was very different, right? There was no bank accounts for these customers. There was no credit bureaus. Mobile penetration was very low. Internet is kind of not really there. And then, the whole premises on which a loan works, like your identity proof, address proof, how do you kind of really go about and, kind of confirm this, then income proof. So many of these things were a kind of real reason why it was kind of largely happening in the physical phase, and also using lots of frontline field officers to carry cash from one end to another end and meet people, hand over something. Then I thought in 13, 14, with the Aadhaar coming of age, and the whole set of innovations happening around the India stack with UPI, a set of innovations from NPCI with the IMPS, and then the whole and a kind of shift that I saw from very large technology, kind of licensed technologies as being the backbone of financial services. People have become more, comfortable about using new age technologies, right? I mean, instead of kind of only dependent on a core banking solution, the real use of technologies, and then the whole API world started coming. So I thought of kind of really imagining, can we look at a cashless, paperless, and using a lot of data science to kind of really underwrite loans, given that we are seeing, the world around us change. To me, the problem still remains very strong problem to be solved. Like, people still have financial access problem, right? And they still want to kind of get a lot more finance, and that remains the very strong problem to be solved. But to me, the world has changed, right? I mean, you have a bank account, you have an Aadhaar to be used, you have seamless fund transfers to customers' account. You can use a lot of scoring for underwriting, and also kind of the new age use of lots of apps, which kind of really generate a lot of data, which used to be in hard papers. So around 13, 14, that we came up with, kind of an app-enabled kind of an enrollment for the first time, built and score to kind of really underwrite customers. Thanks to a bit of the background of my promoter, we also could look at a psychometric score. We thought the credit score only tell us whether the customer has got the ability to pay, but we don't really know the intent to pay. So I thought if I could solve both the ability to pay and the intent to pay, and it's kind of really kind of come seamlessly to kind of make a decision whether this is a good customer or bad customer, I thought we could largely solve the problem of then the whole dependency of your frontline staff. And if he moves on, then we are stuck, right? I mean, the whole experience was with him. And if the guy cannot take you for a ransom that if I move with 500 customers, then you have no other go, because everything is with him. So we could largely remove a lot of this dependency. We could really build institutional experience of the customer. There was a direct connect with the customer beyond the frontline staff. And the frontline staff saw the real power of technology, like, I mean, instantaneous transfer of files, transfer of biometrics, real-time credit. I really remember on the day, like when we, launched the app around 2014, linked with that time as an NBFC, we could use even eKYC. So what used to take an 18, 19 days from the day that meeting the customer to kind of give the money, you could almost do it in half an hour, right? There's nothing more that needs to be kind of done. You do a biometric verification, and on the fly, you take their information, and the app is connected with the credit bureau. It pings the data. You have a data science tool that punches score, and then you have an API link working with the RBL bank and an AEPS working on the side. Then you have really linked, and then you fire it. The treasury is able to kind of send the money. So that was kind of a real wow moment, right? For the frontline staff, been there for 18, 19 days to kind of really meeting the customer query that when will I get the money? Here is it. And also another example was to kind of really see that we have been for the first time able to show the credit bureau report to the customer. Why are we rejecting your loan? Right? I mean, most of the time they tell you, what they had, they have taken from here, there, and all. We all are in the sector. We know that how much of it is true. Then most of the people may hide something. But here is a moment that without you telling me, I can say, oh, you have taken a loan from Ashirwad, which is overdue now, right? You have taken from somebody else. So that they couldn't really believe it. And also a lot of dispute on the ground also could be resolved. Like when we asked the women on the ground, how do you see this? So they said they did not even know that their group members have been defaulting to somebody else. That knowledge itself was not available to them while they were guaranteeing their loan here. So then we could show to them, so we are sitting with this credit bureau of no use to us. But if you know about your own credit bureau, you could repair it, because our end game is to kind of really make you all able to kind of really access this, room. And then we shifted a lot of our efforts to kind of really data science. We built, fraud detection tools. Those are the times that I was really happy to kind of really see. We really saw the patterns of customers who defaults, and then kept on studying each customer who falls to DPDs. And then so I remember those times we came up with something like 13, 14 very strong patterns of default customers in microfinance. And each time a new customer comes, your system is able to check whether the customer has any of these 14 patterns. And if it is there, they're able to kind of then give a notification to the frontline staff saying that we are seeing some of patterns that you have seen in the past default customers with this customer. As simple as to kind of say that the customers who often change their mobile phone numbers kind of largely ends up in DPDs. Customers who often change their KYC addresses. In a span of 5 years of credit history, if you see 3-4 addresses through which they've kind of made the loans, they're kind of more of migrant customer. You have difficulty to kind of just chase them later on. We have seen customers who don't have a continuous credit history with the same institution. It was suspicious to us, like why is they not continuing with the same institution? While the credit bureau tells that they have no default, we were really puzzled to kind of see why are they not taking repeat loans with the customers. We all want to retain good customers. If I have a very good customer, who are going to believe them. So there are many of such things. I saw in a small way microfinance moving from a completely paper-driven, cash-driven, using lots of frontline staff, learning to kind of use a lot of data. A lot of data became available. Right, there are credit bureau data. They're using tabs and all that. There's a lot of this whole profile data become kind of usable because they are no more in papers. There's lots of bank information data because customers all have their bank accounts, and if you're able to kind of access. So I would say kind of this has been a very happy journey, seeing customers progress, mobile penetration kind of really helping them to kind of, I'm seeing the next step, like maybe a lot of self-service customers will come, right? I mean, as they kind of progress to kind of the real smartphones, and the pandemic is kind of really driving that direction a lot more faster. And we are also seeing the whole payment solutions kind of becoming so easy. Customers, very, very, very new age customers, kind of without any kind of proper digital education, are able to kind of make small checkouts or payments using as easy as maybe an kind of Google Pay, Phone Pay. There are many such instruments. So I would say NPCI also has completely revolutionized the whole payment space. And both the innovations happening very hand in hand, right? I mean, on the one end, we are seeing very new age, small efforts of technology is kind of put to good use of underwriting and customer onboarding and the payment solutions kind of really improving.
Yeah, Joby, it is really very well summarized way of how the manual shift has gone, where the transparency in the business, the accountability, and enforcing the processes on the field, giving proper information to the customer, and a very managed tech. That's where the digitization has brought into, especially in the microfinance industry. So coming to Ashish, since Ashish is a kind of person who engaged himself in various deal sourcing, he coordinates with a lot of different kind of financial institutions. He does the portfolio monitoring, risk assessment, and due diligence. So Ashish, looking to the different kind of flavor of the way of working, you must have came across a different kind of transformation in different organization. How actually it is helping Northern Arc?
Sure. So in fact, at Northern Arc, we have a very good cross-section view of different financial institutions across sectors. And the vantage point which we have kind of helps us understand what's happening in different asset classes, different stages of companies. What we saw and last 1 decade has been the period when things have changed and evolved into moving towards technology. And even in terms of the perspective, right? Earlier, technology was talking about ERP solutions. People moving to Tally itself was a big piece. Today, companies talk about being tech-first financial institution, right? The word fintech, where people say that we have digital lenders or technologies enabling lending to us. What we've seen 2-3 trends, and a lot of that was in terms of the infrastructure which was created by government, and like Joby mentioned, India Stack. The whole India Stack was set the foundation for the financial services to become digitized in terms of the end-to-end operation. So 4 things happened, which we saw. One was India Stack made a lot of things paperless with your e-signing, DigiLocker, a lot of the document scraping which was done by many of the service providers like Perfios, Yardley. So today, even for a corporate loan and to underwrite institutions, I can actually digitize the financial statements of companies, right, within seconds. So the technology allows you to read through OCR technologies to read PDF documents, digitize Excel sheets, and that kind of saves significant amount of time and brings in efficiency just for a credit manager to look at numbers. Right? That's one. Second is presence-less with video personal discussions, Aadhaar KYC. You don't actually have to be physically present at place to actually do an underwriting. So people move towards video personal discussions for underwriting, geotagging, asking the customer to geotag where he's standing to ensure that his location is reached. The third was, of course, cashless. Right? People moving towards cashless, and demonetization was a period where it kind of changed the game for many of the people who were kind of holding it back, saying that I'll do it when I get to some stage, and demonetization pushed the pedal on more digitization and being cashless. And we saw UPI, IMPS, AEPS kind of fueling that growth. And now what we see is the 4th layer, which is the consent layer, where account aggregators will come into force, and that will create more access to digital data. And all these 4 pieces put together, paperless, presence-less, cashless, and the consent layer, we think that many of the both traditional NBFC financial institutions will actually evolve and move more digitized and tech-centric. And given how Indian context is that you can't be completely technology-led, right? No fintech company today is 100% fintech. So the fintech guys will actually converge towards the center, again, having a good, more digital model. So we see both the trends where both spectrums coming together and converging in between. And then for us, our own wholesale business and the structured finance business, today everything happens on our proprietary digital platform called Nimbus. So we've digitized every piece of data which we receive from clients, whether it is Ashirwad, Dwara KGFS, Kinara, even Shakti Finance. All these are our partners, and the data which we get is digitized by our team, and that data is actually shared with the clients themselves. And that incentivizes them to actually share more data, digitize more data, and cutting down the tax of processing transactions, figuring out early alerts, red flags in data, figuring out if in terms of risk issues of flagging off, because data speaks. And we have our gold mine of that technology platform is the value of data which we've generated through transactions. And humanly, it's not possible to do that. And systems, underwriting models have evolved with the tech platform, which is enabling us to do it faster. Today, I can proudly say that we work with 200 NBFCs in the country across 8 sectors, including microfinance, affordable housing, vehicle finance, small business loan, vehicle finance, fintech, and agri. All of the data which they've been sending us for a decade is digitized. And that data is available for the clients also to actually use them as their dashboards. The KMPs can actually look at how their business is performing quarter on quarter. And for us also to monitor business on ground. Eventually, pandemic and the lockdown pushed us further. So even our strength was risk management on ground, and we've continued virtual risk monitoring. So today we do a branch visit through a WhatsApp video call or a Zoom call, right? We do we do MIS checks through team viewers and ensuring that we have access and do our check during diligences. We do virtual diligence. So we've actually onboarded 20 companies in the last 3 months in the lockdown, right? And funded 20 companies just based on virtual diligence and ensuring that our work doesn't stop and then we move towards digitization. So even for an organization which is 10-year-old, there is inertia to change, and kind of technology became a necessary evil in this time. And fast track.
That's great, Ashish. So now at least the situation has come for the due diligence or deal sourcing or portfolio monitoring or risk management. You need not to go branch to branch, or someone you can sitting at your office and you can actually perform all those duties without any hitch. And that is where the digitization has come through.
Yeah.
Now we are talking about a lot of things has done. I will go to Dr. Ravindran, because Dr. Ravindran is dealing with a very different kind of organization, a very, very different kind of very, I heard a lot about Shakti Finance and the kind of job they do. And I'm sure Mr. Ravindran would have faced a lot of challenges when he would have come with, an idea of digital transformation. So I would like to know from Dr. Ravindran the challenges which he has faced to, implement certain digital initiatives and how he has managed it. Sir, you are on mute. Dr. Ravindran, you are on mute.
Yeah. Okay. Thanks, Anand and Joby, Ashish. I think that the stage was perfectly set. And digital transformation, for me, I think before going to challenges, I'll briefly highlight what actually we are covering under that. Then in line with that, I'll probably talk about the challenges also. Basic ERP, CRM, and infrastructure, hardware, networking, connectivity, etc. Or it's all set. Gone are the days, they were on the priority, of all CEOs now. Now the scenario of digital transformation is highly prevailing. And I can say now, in my proudly 4 decades of experience, the past 3-4 years or 5 years, the changes are happening in the IT field under digital transformation was humongous actually. I think whatever we were doing earlier or just setting the stage only. Now only we started playing, and the role of CEOs are very eminent on that, considering the pandemic situation, etc. And I focus on in the digital transformation. One is enhancing the customer experience. We call that CX is one focus. In fact, Joby touched upon nicely on that. Customer all should be contactless environment. They want to do business with us. And again, as you start talking about the fintech thing, etc. So we are seriously working towards that, because our customers again are different customers. Like you rightly said, sir, Flexi Finance is different because again we provide higher purchase finance for pre-owned heavy commercial vehicles. That is truck operators. Even a guy with a small van, I think he's our customer. And the level of education and the level of the literacy and awareness of the IT part, the savviness, etc. It is not at par with other customer bases. In fact, I'm mentioning this is one of the challenges actually. And we are a deposit-taking non-banking finance company. Depositors are in a different segment, and higher purchase customers are in a different segment. The expectations of higher purchase customers are different, and depositors are different actually. So we have to align in such a manner, the deliverables and in applications we have to provide that. But that is the need of the hour we have to do, especially the current VUCA COVID scenario, that is very imminent. So one challenge is like identifying the right platform to make that reach better for the type of customers what we have is one part. So we use all media, nothing wrong. I can mention WhatsApp. We feel its reachability is good for our customers than any other media. Emails they are not seeing, and we also do a lot of digital marketing for deposits, customers, etc. It works well, but again it can't work well for our HP customers. So that is one part. And second, coming to another pillar in digital transformation is enhancing the operational excellence. We call it as OX actually. So it's a right opportunity, or it is mandated to enhance the processes what we are doing or we are doing to the better level of supporting the digital transformation actually. Like again, I think Joby was mentioning that turnaround time reduction. I think we were talking about days earlier. Now we are talking about minutes. But the problem, another challenge we have here, the management expectation. Why can't we make it in seconds? Okay, so this is actually another expectation from CEOs, no doubt. But this is another challenge we feel. One side, the management expectations are high. Another side, we have to really see the customers. And the third, I think the internal stakeholders. The change. I think whatever we do, the change management is very, very important, because the digital transformation should get aligned with all the stakeholders, then only it be effective. So there is another challenge is the change management actually. One more challenge, I think this may be a common experience for all. I make it as very generic. I think sometimes we'll get sandwiched between the CEO and CFO. Okay, so we have a lot of ambitious plans. We project this is the way we have to do. CEO acknowledges immediately, yes, Ravi, go ahead. But the CFO, I think he's a valid person. I'm not doubting. I think they're objecting anything at all. But the challenge is what normally we face. We have to do a lot of homework. We have to really see. I think this is applicable for all CEOs. Among the right technologies available, we have to scout around. We have to choose, compare. Sir, this is needed. I think there are options available. This is the best and cost-effective one to convince the CFO. I think this is it's a job of CEO, but I can take it as a challenge also, especially in the current COVID situation. And one more challenge, very important one, what I think all the CEOs and we also face on the security angle. See, the information security, it is I think it is, though evergreen, I think the vulnerabilities are growing very high. And I think you would have seen a lot of reports like ransomware attacks are on the very high rise, especially in India. So the CEOs, though one side we do SMAC, I think I'm an evangelist of SMAC, social, mobile, analytics, cloud, again, everything is perfect. But again, we have to take care of that security angle with a constant vigil. That is a very, very critical and challenging job for any CEO. Last but not the least, another challenge we have to face, again, is a part of CEO, but I'm slightly tainting with a challenge because of the compliance. I think you all can agree, non-banking finance companies, we have to adhere for the compliance in multiple angles. I think starting from RBI, SEBI, even Joby touched upon about the CIBIL part, rating agencies, and even we have to comply the requirements of the ASHIS, especially when we request for some fund from them. There are a lot of things. I think I used to enjoy providing the data whatever they ask. Okay, so this again I'm repeating. It is I'm not telling as a requirement, but this is a challenge altogether, because management, as far as NBFC is concerned, the compliance part, adherence, it is very, very important. So taking care of the external stakeholders, internal stakeholder, and the statutory part, and the invisible stakeholders, that attackers. I think all these things we have to take care, and this will be the job as well as the challenges for us. Anand.
Very well articulated, Dr. Ravindran. So if I summarize it, there are 4-5 important points which you have suggested. One is, first, the customer segment, the digital transformations or the solutions should be built looking to the different customer segments. The second point is, it is almost need versus the pocket. The third is, it is as on today or yesterday. And fourth, definitely the security aspect. Now, I'm going to the very passionate person who has been with a different kind of organization with different DNA. GD, for you, where we stand when it comes to digital transformation, and where you would like it to see in next couple of years? You are muted.
I think organizers have to unmute here.
Can you hear me now?
Yeah. Yes.
Okay, thank you, Anand, for that interesting question. And heard the other panelists who have actually spoken a lot about what's happening and their journeys. And having come from MSME lending company, we are predominantly into unsecured lending space. Right from customer onboarding to underwriting, to the decisioning process to disbursement, that's a very complex process, right? So, the kind of information that we need to capture about the customer to understand the customer's, background, and hence, the ability to disburse the loan fast enough has always been very challenging. In fact, we are a last mile financial inclusion provider for small business entrepreneurs. So, you won't find them somebody who is very, very digital savvy. In fact, these are typically people who are about 35 years of age and who are not having that kind of a tech infrastructure, and they don't have that kind of, time. So if you go to these small business entrepreneurs, factories and shops and all, you see them, busy with running their machines, small little machines, right? Or even, those little shops. So we are actually dealing with, the businesses that are at the lowest end of the value chain, I would say. However, these are the businesses, or these are the contributors, biggest contributors of our country's economy, right? So from that perspective, it becomes our role, become a very critical, bridging role. So from the very beginning itself, Inara has been highly digital enabled. In fact, we have used, as the other panelists also talked about, we have used every bit of technology available were available at different point in time to enable our business from the beginning itself. In fact, I would like to also mention that we have from day one implemented all cloud-based applications. We have not built any database of a data center of our own. We have tried to connect with the available technology ecosystems like India Stack and various other systems over a period of time. But if you look at what happened in the last few months with COVID coming in, see, every business across the world has been challenged and forced to look at or rethink or relook at the business models, because your ability to, we used to tell our people to go to customer, right, all the time, because being the last mile finance provider, our people need to be on the ground with customer, right? But now there is a huge paradigm shift that has happened in the last few months with COVID hitting the businesses. So interestingly, we were fairly well prepared, I would say. In fact, I'm very happy to share on this forum that the entire multilingual contact center, we were able to shift to work from home model in a matter of few hours, right? Because the beauty of being on cloud, being flexible, right? That capability to some extent we have built into our IT roadmap or IT strategy much earlier. So fortunately, the COVID time, we did not face much problems in moving people to work from home or, enabling the customer service, even while people were away from customers physically, right? Now, coming to what has been happening now is very interesting. In fact, a lot of these customers who are not so much tech savvy, we are finding they are all becoming savvy now, because there is no other option available for people to do any kind of communication or transaction, with the external world. So in fact, we have actually conducted a survey post the lockdown time. In fact, in the recent days, to figure out that how digital savvy our customers have become now, because the time before was very different, but the time now is very different, right? So for a business lending company, for us, there are two vehicles which run our business. One is our collection and second is our disbursement. Of course, during the days of pandemic time, the company has slowed down our disbursement process because we wanted to see businesses were also shut down, right? But at the same time, we also wanted to relook at our, our credit underwriting process, our, risk management strategy, sectoral approach, and all that, to figure out that, how things are panning out. So we literally slowed down our disbursement, but we put a lot of thrust on collections. Now, with even the moratorium announced by the government, RBI, still a lot of customers were able to pay, because we kind of tracked down every single customer, month on month, week on week, day on day, from wherever our employees are. They used to make calls, figure out how customers are, how their health condition is their business operating, are they okay, and then can they make the payment, right? So, and we have been able to, and though it posed a big risk and uncertainty at the beginning, we realized that we have been able to do very well on collections. Now, one reason was that we have actually fast-tracked our collection digitalization to such an extent that today we have got more than 2,000 touch points. We have literally, as Joby and Ashish talked about how the ecosystem has enabled, right? So this wasn't possible many years ago, but today the ecosystem is available. Now there are so many avenues available for customers to pay, right? So if you look at, we have actually the first thing immediately after the lockdowns were announced, and luckily we already had a Razorpay payment platform where customers could come through our customer app and portal to make the payment. which is connected real time with our LMS load management system. At the same time, we immediately initiated our dialogue with the Bharat Bill Payment NPCI to enable us across all the payment apps. So today we are a builder with all the 400 plus UPI apps available through the Bharat Bill Payment Services. So this was a very super fast track project that we have done, and we were able to get a lot of our customers start paying through that route. And then we have also tied up with the Airtel payment banking, the channel. And today, with all the outlets, almost 1.5 lakhs outlets are there, right? So our customers could walk in and make the payment if they are keen to pay by cash. So we have catered to the needs of cash payment customers and the digital payment customers. Now, the other thing is on the disbursement. So we have actually started looking at the disbursement aspects. Before that, we did a survey on a good base of 20,000 customers to figure out that what is their readiness, because business lending is not easy process, right? Customer has to go through that journey, and is it something which is going to be useful for customer if we build something which is truly digital. So to our surprise, we found that 55% of our customers have said that we are now ready to transact with you or do the process in a truly digital way. That gave us the motivation to quickly come out with a completely different digital system, which is completely new generation, I would say. We have connected with every possible ecosystem through APIs for KYC validations, for bureau checks, for bank statement analysis, digital signature, even disbursement, so end to end, and that too connected with the data sciences algorithm, which automatically takes decision. So if the quality of file is good or customer is good, then we are able to today disperse in minutes. And the same application is going to come out as a, we are looking at, so Kinara's advantage is that we are basically, we run our business on a blended model. So while, if customer is happy to do the transaction end-to-end online, very good, but we have a great feet on street who can assist the customer in taking care of the last mile touch point requirement. So actually rolled out this application. We are in the process of upgrading it, bringing it to the next level and all that. But what I'm trying to say is that what we wanted to do over the next maybe 18 months, COVID has really helped us fast track or pushed us to fast track some of these initiatives or transformations. And I do think that next 3 years, 4 years horizon is very difficult to predict, because what we have seen in the last few months was completely unparalleled, right? So I think we need to live in the moment, make our systems future ready, so that something like this happens, the business is run, and at the same time, I think what we are building today is going to stay for a longer period of time. So my takeaway is, Anand, I mean, my take is that the technology that you need to build today needs to last for a longer period of time. There are enough and more ecosystems. Look at the, the 4G telephone system or connectivity available. So today we have got a good amount of connectivity. Penetration level is very high. The tech ecosystem is very good. So I think there is no better time to build the best technology systems today, which is more, customer friendly, which is more transaction driven. And that's going to be the future. And I'm sure, in the coming days, more and more organizations will be adopting to these kinds of solutions to run the business.
Thanks, Gigi. I think that you have very well explained that as far as the business is concerned, it is completely transformed. Almost the front office or the feet on the street has been completely transformed. But according to me, there is a lot to do when it comes to back office, as Dr. Ravindran was talking about operational excellence. The back office part, the finance department or the HR part, this is where I think that the shift needs to go, because even today, if any organization is using email services to take certain approval, it means we are not completely digitally transformed. For me, email is just for communication. Rest, if you are actually digitally transformed, then there is a transparency, there is accountability, and information moves from one place to another place without any manual intervention, and people should get intimated that you have to do this. The second part, according to me, where we should actually, and the tech company should look after, is looking to the geography and literacy of our customers or the employee. Since pertaining to microfinance, the technology which can handle regional languages, the voice-based solutions or bots which can understand at least 6 regional or 7 regional languages, which is Tamil, Telugu, Kannada, Malayalam, Hindi, Marathi, Bengali, and Odia. Though we have 22 official languages, 600 plus dialects, and 50% of the population only can communicate. They can talk, they cannot read or write. So actually the transformation should go to that level. And second thing, the back office digital transformation and automation, which includes the risk-based audits, risk-based monitoring of the customers. Though the effort is there, but we have not reached to that level. So my last and final question to each one of you would be, I will start with Joby. Tell me one thing, if given a chance, you would like to do it in next 6 months.
Please mute.
I completely agree with you, Anand, that the direction that you said about the future is about the vernacular voice. Because of very unique setting of our country, many people can't read and write, and then kind of voice then is something which we can't really avoid, and then it's the vernacular language. Our focus at Dwara KGFS used to be kind of always remains very close to the customer centric, and we build technologies only in the customer experience piece. And so the way that we are kind of aligning ourselves is to kind of see that, put our hands on whatever it takes to kind of really enhance the whole customer experience and build huge API integration capability. Because there are so many vendors, there are so many technologies, there are so many solutions. So the future is going to be a lot more collaboration, right? It's the age of the large, kind of, single operator led, kind of services. Has its own limitations. I would see kind of there are small services that everybody provide, and the new age technologies does provide the confidence and the framework to kind of hugely collaborate. And as we speak, lots of these innovations have already happened in terms of the whole processing side, right? Whether it's digital signature, documentation, kind of onboarding. And I agree with you on the back end. If it have to kind of really see that a full transformation is about all your functions are able to understand data transfers kind of really smoothly across all of that. And I would see that, kind of the whole, as an NBFC, I am very bullish that the whole eKYC comes back. And I'm seeing kind of some of the whole conversations around there, because this is kind of lots of area where the video KYC and all of that is there, but nothing is as easy as the original Aadhaar enabled eKYC. And there are, kind of government is seriously thinking about kind of that's bringing that back for the NBFCs, because they are the ones that's kind of largely there on the last mile to kind of really do that. So I'm very hopeful that happens.
Thanks, Joby. Ashish, do you have some suggestions for NBFCs or MFIs, something which they should take it immediately to, be in the radar of the investors, or, it is with respect to technology?
Yeah. So I think, in fact, two critical things, and then one which is taking a cue from what you said in terms of there are critical functions which still needs to be digitized, like the finance team and the treasury. Two things. One, in terms of they need to capture more data about the client, right? And specifically microfinance customers. So today, companies are monoline, just doing cookie cutter business. But we will see that the client needs evolve, and companies have to prepare to actually cater to that. So we need to capture a lot of digital footprint and digital data, and have technologies to actually consume that data and give outputs which are usable. That's one. Second, something which we are helping our clients to do on the technology front is digitize the liability side of the business. Right? Everyone focuses on assets like LOS, LMS, and credit underwriting. We are digitizing the liability side. So if a chief treasury officer or a CFO wants to get instant reports, say, and manage all his lenders on a digital platform, that's what something we are building. And in 6 months' time, we should be able to integrate with these clients. So we want to cut down the lead time in terms of data sharing, because you share 50 reports to 50 lenders and the data is the same, right? 50 emails and 100 emails month on month, right? And if it's on a common platform and you give access to your lenders, it's just one email upload. Right?
That's great.
And something which we've started, and all our partners will see that in the next couple of months, having access to that.
Dr. Ravindran, you let me just tell us briefly in few words, what is the role this new age fintech companies are going to play?
In my views, I think the fintech enablement, will lead to 2-3 advantages for the NBFC community. One is like reaching the customers, like an enablement for the customers to tap our doors to get the business. Maybe like the model of maybe the Canara Capital or some other companies, like again contactless transactions. I think still our case and all still our customers, they visit the branches, and so many transactions happen to collect the details, etc. are there. But the fintech enablement, one great way it will happen, it will be a contactless customer service business, and obvious the reduction of TAT. I think this is the one major advantage.
Dr. Ravindran, I think that you are trying to say like neo banking, open banking, or API banking, which is limited to the banking sector. The similar concept should come to the NBFCs and MFI as much as possible.
Precisely.
Am I correct, sir?
That is the one core point I want to make it actually, as far as the fintech enablement is concerned.
I think that Gigi ma'am, the final question to you would be, how digital transformation is going to impact the productivity of the employees? So far we are talking about customers.
Yeah, certainly. So ultimately, by making things fast and easy, is going to ultimately add to the productivity level of our employees, right? So today or yesterday, our employees were spending days to collect information from customer, to pass it on to the underwriting process, risk assessment process, and the onward, the scoring and the approvals and disbursements and that process. Today, when you connect the partner ecosystem and able to quickly get the information accurately in the fastest possible way, that is adding to the employee's productivity, right? So something that an employee in the field, a loan officer, was able to do in 3 to 4 days time, if he is able to do it, in a matter of maybe few hours or few minutes, that adds the time back to his productivity, right? So I think it is going to hugely enable, these digital processes are going to enable our employees to work faster and in efficient way without losing sight from the quality, because quality is another big aspect, right? So otherwise you will have to constantly audit what people are doing. Is the KYC right? Is the information given right? But if all these information are validated upfront, then things become faster and at the same time efficient. That's on one side. Second, we need to also enable them with the right communication technologies, the right tools, the right systems, right, the right devices, so that they are able to operate in the most efficient way. So I think the digital
yeah, that is very valid. So what we have learned today is that we need the connect, collaborate, communicate. This is the key factor. Now we have to get rid from the normal way of working and start thinking about virtual laptop or desktops or workstations. We have to automate our processes as much as possible. Front end processes are almost automated, but still the back end side we have to do a lot. We have to create a system by which we can give access to our investors, lenders, and whosoever. They can actually view our data and all those things. And ultimately we have to work on seriously on the voice based regional languages solution, which can actually make India as a digital country. So thank you so much, each one of you. It has been a wonderful session, and I actually learned a lot from all of you. Thank you so much.
Thanks, Anand. Thank you, everyone else.
Thank you. Have a nice day, everyone.
Thank you.
Thank you. Have a nice day.
Thank you so much, eminent panelists and the moderator, Mr. Anand Sharma, for a great, insightful discussion on the role of digitization and digital transformation in NBFCs. Thank you so much. And now we will be moving on to the technology presentation. And this presentation is on Thales CPL Presents Data Protection Platform. And this presentation will be delivered by Mr. Prasoon Srivastav, who is Senior Solutions Architect for India and SAARC region, Cloud Protection and Licensing in Thales Group. So here I invite Mr. Prasoon for the presentation.
Hello, everyone. My name is Prasoon Srivastava from Thales Group. I'm a senior solution architect, and today I would be discussing our data protection product line in a little bit of detail to introduce you to our approach, which we feel is very relevant to current data governance environment and current challenges that we see when it comes to data flow in hybrid infrastructure environments, from on-premise to cloud to various services, so on and so forth. So before I get into the details of the product, I just wanted to give you a brief description on what are the challenges that we saw out there in different organizations, and why exactly did we choose to go the route that we had gone. So the biggest problem that we encountered in many organizations up till now has been deployment of security solutions in silos. So while there are implementations of storage system encryption, application level protection, file server level protection, big data protection, etc. In many different organizations. However, there is a lack of consolidation in terms of a single glass pane view of all those security controls, and whether or not those controls are being managed and maintained properly from a single platform, such a solution is currently not available. So this we took up as a challenge. We did understand that a lot of risks were being left unaddressed in this fragmented approach, and not everybody was able to evaluate whether the technical controls in place were actually doing the job that they were supposed to do. So with this in mind, we decided to create a common platform from which all these data protection measures can be managed, provisioned, and controlled, so that all the policies associated with these technical controls remain uniform, and the security officer is able to get a single glass pane view of what actually is happening in the current domain. So with this in mind, we created a platform called Cypher Trust Data Security Platform. We in fact not only do data protection and control, but we also added the ability to identify sensitive data in the form of a data discovery module within the same platform. So from this single platform, we are able to identify and classify sensitive data which is dispersed within a current organization, be it on premise or on the cloud or within services, applications, or wherever they might reside. And post identification of sensitive data and measurement of associated risks and identification of the data flow within an organization, the same platform is able to provide adequate data protection measures depending on the type of controls that are needed to be implemented for a particular scenario. This platform is able to provide a variety of data protection measures, which is not limited to data protection at rest. It also addresses data protection in motion, and it is able to give provide top of the line technology associated with encryption, which allows the lowest overhead in terms of encryption. And the encryption technology is applicable to all layers of data, whether it be lying within databases or within file servers or within application services, or even at the storage or virtual machine layer. So the same platform has a variety of solutions created within it, which is able to address all those endpoint requirements. In addition to that, we have always firmly believed that key management, when done securely and in a segregated manner, is able to provide the necessary security controls associated with encryption. A lot of technologies today use encryption. However, where they essentially fail is they keep the management of the keys in the hands of the same stakeholder who is also handling the data or the data encryption. So in such a case, there is no segregation of duties, And because of lack of segregation of duties, there is always a potential risk of this sort of technology not giving the results that are necessary. But with our platform, we are able to keep the key management associated with this technical control independent, and because of that there is segregation of duties, and security around such implementations can be really achieved, and the total cost of ownership really becomes evident in such a scenario. The same key management techniques can be used to address concerns around data ownership on public clouds like Amazon, Google, Microsoft Azure, so on and so forth. And it goes ahead and gives the same benefits or value associated with key management when you use it on the cloud. So Cipher Trust Manager, in essence, is a very flexible, scalable, and efficient solution that goes ahead and provides these technical controls, and also integrates with on-premise security intelligence or CM tools to provide a very detailed, clear picture of the controls and their behavior in an organization's environment. Now, with data privacy also coming up strongly as a requirement in various regions of the world, we see a value in providing technologies like data discovery, classification, and automatic remediation of data privacy related concerns in an organization. We do realize that one of the major challenges in today's organization is actually figuring out the dispersed way in which data resides. And sometime more often than not, the larger risks usually come up where from an unknown location, where some of the critical or sensitive data might be residing without anybody's knowledge. So in order to address these particular concerns, we feel that data discovery and classification should be a very important part of any data associated security platform, and hence we provide the same thing within the same platform. So it all starts with the Thales Cipher Trust Manager, which in this particular photo is being shown as a hardware appliance, but is also available as virtual appliances which can be managed on any virtualized infrastructure. All the security credentials, certifications which Thales normally associates its products with is all present with this product as well. And our hardware and software is already been tested as per FIPS mandates. Coming to a little bit more granular detail of all the encryption options and other technology which is presently available with this platform, I would like to describe Thales transparent encryption with live data transformation in a little bit more detail. Thales transparent encryption is actually a very unique technology which is patented by Thales. This solution allows you to encrypt the data at rest in such a way that it has a very minimum impact in terms of overhead. The maximum overhead would be somewhere around 4% to 5%, depending on the data resident location. And the same technology, the same encryption technology comes with a very robust policy based access control and privileged user access management system that allows very granular control of data access in any organization. And it allows integration with available CM solutions that do continuous reporting on type of data access that is done within an organization, and any anomaly or any irregular data access, be it from users or even from application processes, the same are reported and highlighted via this solution. So the policies are centrally managed within our Cypher Trust Manager. Policies can be defined in terms of resources, the kind of actions that you want on those resources, the kind of effects you would want to see when a user or an application process tries to access the resource. So all of these are managed by the centralized deployment of Cypher Trust Manager. Whereas the individual data which resides in different locations and file servers, databases, etc., are protected using an agent-based approach, which is deployed on local servers. The auditing and reporting capability of the solution is quite intense. In fact, it even allows reporting of data access via malicious processes. So if there is a particular application process which is not used to accessing a particular data and still goes ahead and accesses it, all those things can be reported and stopped easily from this central solution. So it does provide a very a good tool in terms of any post-breach forensics or even any post-breach post-breach data theft. So live data transformation technology is another useful piece of this same solution. We all have faced challenges in deploying technologies like encryption within organizations, and we have realized that it is very important to ensure that the encryption technology used is least intrusive as possible. And our patented technology allows for encryption to happen without any disruption to normal user processes or normal business continuity processes which are running within an organization while it is being implemented or deployed. So that is very critical when it comes to sensitive production deployments which need to be live all the while. Specifically in today's scenario and COVID-19 scenario where services and their availability are absolutely critical, technology like this allows a lot of flexibility. We also provide, apart from data at rest encryption, we also provide data in motion encryption as well. So our solution can integrate with application processes and services and provide the necessary not only encryption but tokenization, masking, and other associated solutions which may be required depending on the use case where the data is, the application services are running and the application is being used. So this solution is able to address application level protection as well for data in motion. When it comes to cloud key management, we all know that whatever be the model of deployment for cloud services, whether it be IaaS, PaaS, or SaaS, the responsibility of the data always resides with the consumer of those services and never with the cloud service provider. So all major cloud service providers have a shared responsibility model, and under that model, data ownership always resides with the consumer. So the protection of this data, while it resides within cloud storage or within services invoked within the cloud, becomes very critical, because as you know, in any shared infrastructure, this type of data, there is a huge risk that comes to this type of data. So we provide solutions to do effective key management, which ensures complete ownership of the data to the consumer in any such deployment. So this technology is very critical, and we see this as a very important future technology to be implemented. So our data protection platform is able to protect data in multiple places wherever they reside, whether in services or different locations within a given infrastructure. We are able to start with identifying and classifying sensitive data and then progress to protecting them using various techniques that our platform is able to provide. We are able to do effective segregated key management that allows these security policies to be managed properly without any collusion, so that there is no risk of this data being leaked. And we are able to do authorization access management based on users, processes, applications, and so on and so forth using the same platform. And the platform can easily address both on-premise as well as cloud-based deployments. So we, with this, we would like to conclude our presentation, and I would like to thank you for giving us the opportunity to discuss our technology in a little bit more detail. Thank you very much for your time.
Thank you so much, Mr. Prasoon Srivastava from Thales Group. It was really an insightful technology presentation. And with that, now we move on to the lunch break. And I again request all of you to please visit the expo. And I look forward to see you all again after the lunch. Thank you.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना रुतबा खड़ा किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं। और ये मेरा साफ मैं हमेशा कहता है, आईटी प्लस आईटी इज इक्वल टू आईटी। इंफॉर्मेशन टेक्नोलॉजी प्लस इंडियन टैलेंट इज इक्वल टू इंडिया ग्रोथ।
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection regulations, and aren't addressing new hacker tactics, leaving organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by an overburdened staff will never meet today's compliance and security challenges. An easier and unified approach to discover, protect, and control sensitive data everywhere is the only pragmatic way to protect your organizations at the rate and scale required by today's risks and transformation initiatives. Data security and compliance starts with finding your exposed sensitive data before hackers and auditors. This data can be in many forms: files, databases, and big data, and can rest across storage on your premises, in clouds, and across backups. Once you've identified databases and file systems that contain sensitive data, you can then apply data-centric protection, such as encryption, granular access controls, and tokenization. For encryption and tokenization to successfully secure sensitive data, the cryptographic keys themselves must be secured, managed, and controlled by your organization. Finally, virtually every data security regulation and mandate requires organizations to be able to monitor, detect, control, and report on authorized and unauthorized access to data and encryption keys. The CipherTrust Data Security Platform is an integrated suite of data-centric security products and solutions that unify data discovery, protection, and control in one solution. Thales has pushed the innovation envelope to remove complexity from deploying data security, accelerate time to compliance, and secure cloud migrations. The platform provides powerful tools to discover and classify the data that your organization should be protecting, Protect against external threats and insider abuse with robust encryption, granular access controls, and tokenization strategies. Control your data wherever it is stored with strong centralized key management. The many solutions available on the Cipher Trust Data Security Platform can be deployed individually or in combination, so you can secure your organization's most sensitive data without increasing deployment and operations complexity. This results in less resources dedicated to data security operations, ubiquitous compliance controls, and significantly less risk across your business. You can rely on Thales to help you discover, protect, and control your organization's most sensitive data, wherever it resides. To learn more, visit Thales' Cipher Trust Data Security Platform.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना रुतबा खड़ा किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं। और ये मेरा साथ मैं हमेशा कहता आया हूं, आईटी plus IT is equal to IT. Information technology plus Indian talent is equal to India tomorrow.
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection regulations, and aren't addressing new hacker tactics, leaving organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by an overburdened staff will never meet today's compliance and security challenges. An easier and unified approach to discover, protect, and control sensitive data everywhere is the only pragmatic way to protect your organizations at the rate and scale required by today's risks and transformation initiatives. Data security and compliance starts with finding your exposed sensitive data before hackers and auditors. This data can be in many forms: files, databases, and big data, and can rest across storage on your premises, in clouds, and across backups. Once you've identified databases and file systems that contain sensitive data, you can then apply data-centric protection, such as encryption, granular access controls, and tokenization. For encryption and tokenization to successfully secure sensitive data, the cryptographic keys themselves must be secured, managed, and controlled by your organization. Finally, virtually every data security regulation and mandate requires organizations to be able to monitor, detect, control, and report on authorized and unauthorized access to data and encryption keys. The Cipher Trust Data Security Platform is an integrated suite of data-centric security products and solutions that unify data discovery, protection, and control in one solution. Thales has pushed the innovation envelope to remove complexity from deploying data security, accelerate time to compliance, and secure cloud migrations. The platform provides powerful tools to discover and classify the data that your organization should be protecting, protect against external threats and insider abuse with robust encryption, granular access controls, and tokenization strategies. Control your data wherever it is stored with strong centralized key management. The many solutions available on the Cipher Trust Data Security Platform can be deployed individually or in combination, so you can secure your organization's most sensitive data without increasing deployment and operations complexity. This results in less resources dedicated to data security operations, ubiquitous compliance controls, and significantly less risk across your business. You can rely on Thales to help you discover, protect, and control your organization's most sensitive data, wherever it resides. To learn more, visit Thales' Cipher Trust Data Security Platform.
Hello, everybody. Welcome back after a short break. Hope you had a good lunch. And now we will be moving on to the next panel discussion of the day. And this panel discussion is on the topic robust tech usage and the rising risk during new normal. And I introduce the panelists, Mr. Kunal Katpal, Chief Risk Officer of Hinduja Leyland Finance Limited, Mr. Dominic Vijay Kumar, Deputy Vice President and Head of IT and Security in Art Housing Finance India Limited, Mr. Kaushik Khanna, Retail Credit Head of Clicks Capital, and Mr. Anil Kumar, Chief Technology Officer of Via Finserv. And the moderator for this panel discussion is Mr. Deepak Mudalgikar, who is Chief Technology Officer of SBFC Finance Private Limited. I request Mr. Deepak to please take over from here, and we look forward for an interesting panel discussion on this very interesting topic about the new normal. Thank you.
Good afternoon, everyone. First of all, a warm welcome to each and every panelist, my esteemed friends. Let me welcome Kunal Katpal, Chief Risk Officer from Hinduja Leyland Finance Limited, Dominic Vijay Kumar, DVP and Head IT and Security, Art Housing Finance Limited, Kaushik Khanna, Retail Credit Head from Clicks Capital, and Mr. Anil Kumar, CTO from Via Finserv. So let me start this panel session first on the robust tech usage and the rising risks during the new normal. Now, the thing is, first of all, we had this entire COVID-19 pandemic had changed the life as of now for us. At the rate the infections begins to slow down, we have seen the early signs of recovery at this point in time, but it has really taught us a lot. Some of the cities and states are slowly starting to open, and hence the business are coming up. While the protective practices we learned and followed in March, April 2020 can continue to protect us and our family while slowing the spread of the coronavirus, we have completely rejigged the way organizations will function and systems will function. Before we talk about the new normal, I would like to know what challenges faced during the lockdown and how those were addressed. If I can start with, yeah, Dominic, you can start. Otherwise,
okay.
Yeah.
Good afternoon, gentlemen. Okay. With regards to this, especially the new normal and the kind of activity, the kind of challenges we faced, which was an unscheduled, unpredicted kind of activity, which happened somewhere in the month of March. Okay, where the complete system had to be shut down. You know, the complete working environment from the offices has to be shut down, and people have to start working from home. So there were three challenges which I faced. One was, the main thing was my logistics, because there were a set of users with laptops, set of users without laptop, and a set of users only on the mobile phone. Second thing was the kind of connectivity every user had, because many of the users who were working at the ground level were dependent on the internet connectivity. That's one more challenge. Second thing was getting the logistics done for all these people. You know, getting the laptops done, configuring them VPN. Because there are two set of people what we have. One is the desktop and the laptop users. The laptop users already had a pre-configured VPN, but the new set of users who we had given a laptop, we had to configure VPN, and it was really a challenging task for us to get things moving. And kind of infrastructure, the kind of internet connectivity at the locations we had was a major challenge for us. So initially, first 2 months, we had a major challenge, and gradually we had to accelerate in a different way. Then, you know, there was a little bit of flexibility which was coming in, which made us to not 100% streamline the solution. Yeah, 100%, 50-60% we were able to streamline and get the business going. And the one very important thing was our cloud infrastructure played a very, very major role, because dependency on my data center was minimal, because we had to have an engineer on site, which was technically not viable. So the cloud infrastructure played a very big role for us during this lockdown, and basically a new normal. These are the few challenges which I faced. And yeah, we had other things also, which was more of an operational requirement. But technically, these were the issues as an IT head and security head we faced.
Thanks, Dominic. That was a detailed, very well articulated, steps that you had taken out. Anil, what's your thought on this one? How you took care of this entire episode over the last 6 months?
Yeah, in fact, like as Dominic mentioned, we too faced like some of the challenges what he had mentioned, except for the infrastructure side, because as a company we adopted like cloud first strategy. So all our transaction systems and all our people, they are equipped with remote connectivity. And in fact, just before the announcement of lockdown, like we did couple of dry runs as well with our employees from remote connectivity. So our field employees, they have cloud and they have mobiles and they are all connected to cloud, and at HO as well. We have the required infrastructure like laptops for everyone and connectivity. We ensured that. So pretty much on the infrastructure side, we were prepared, but then it did pose some of the challenges like on the field, like our employees got stuck at their home locations. They went over the weekend and they got stuck and we could not open our branches. And in some areas, like when the lockdown norms were relaxed, we could not open because there were pressures from the local people, like not to conduct any activity in their vicinity. And then some of the branches are located in containment zone. So those kind of business challenges we had. And apart from that, like one main challenge was like even if customers were willing to pay, throughout this lockdown period, we started engaging. Though we were not working from our offices or branches, we started engaging with our customers. So we kept on calling them and to inquire like how they are and what safety measures need to be taken during COVID times. So that engagement process was live. Like though whether we conduct center meetings or not, still that activity was happening. And then another thing is like we took this time to initiate like some of the initiatives like cashless collection. So customers who were willing to pay and who have like one of their family members who has like a smartphone, so they did transfer us amount to our accounts. So that is some of the things. And one more major, a couple of them are like some of our employees got affected with COVID during this time. Like about 15 to 20 of our employees, they got affected. And we granted them like paid leave, of course. And we also took COVID cover for them. So that brought in like a sense of togetherness and caring for employees as well. And another thing is like on technical front, we did face challenge in applying moratorium, because moratorium was initially scheduled to be applied on June 1st onward, like till May end, but then again it got extended by another 3 months. So implementation of moratorium was another challenge which we had to do.
Thanks, Anil. I think you touched upon the right point, application of moratorium in the system. I think challenge here is one, making system ready for application of the moratorium. And second thing, some of the customers opting then not opting for, it's the interest of the organization where we educated customers to not to go in for a moratorium because we know that interest on interest is going to be heavy on the customers.
It comes with the burden.
We also educated them. But the challenge is post education, some of the customers came back little later saying that we do not want moratorium, but then reversal of moratorium in the system and all. I think you very well said this point, which is from the CTO point of view, I can really understand what does it mean from the system point of view. So having said that, Kaushal, Clicks Capital being a digital company, I'm sure you'll have less number of challenges, but still, we would like to hear from you on this.
Yeah, Deepak, my name is Kaushik, not Kaushal.
Oh, sorry, Kaushik.
Yeah, Deepak. Yeah, so I think most of the things what Dominic and Anil have told. Yeah, on infrastructure side, I think the biggest challenge was because all the employees who were not having laptops, but mostly 90-95% of our employees were having laptops, so we have not faced that challenge. I think key was that how we can have proper connectivity, how the proper VPN network, because there are certain important applications which you don't want to expose once people are working from home. So I think what we asked everyone to download that VPN as a service so that they can access all the important applications, LOS, LMS required for loan booking and some other critical applications while logging the VPN also. I think that was the most important part. Second was, the another critical part was moving to cloud, because once people were coming to offices, all, I think, different security applications, security patches, everything was there on official network. But once everything moved to cloud, I think that was also very, very convenient for everyone. We moved everything on cloud. So we are a cloud company as of now. Some other important challenge. See, once the lockdown started, we all know the business volumes scaled down. There were some other challenges for which everyone was gearing up, like moratorium, which was the biggest thing. How you can offer moratorium to your customers digitally. I think that was the biggest challenge, because once the government announced that moratorium in the month of April, everyone, so I think we took a pioneer role over there, and we designed the complete digital journey with seamlessly and in a customer friendly manner, the way customer can come to our website or call through our call center, or might be a bit.ly link sent through a SMS, and the entire journey is designed in such a manner that it was just a 5-minute journey where you have to apply for a moratorium, and you can see all your combinations, what is the additional interest you will pay, if you will opt for 2 months, 3 months, 4 months moratorium. I think we did that beautifully. Our entire technology team, along with product team and risk team and operations team, did that wonderfully. Second was, the another important challenge was once the government announced the ECLGS scheme.
Yeah.
I think again, most of the banks, most of the NBFCs were still not operating. I think again, we designed the complete digital journey, starting from onboarding to underwriting to fulfillment to disbursal. How that can be done, not even a single employee traveled to our office, and everything was managed in such a seamless manner that we did a disbursal of more than 150 crores in 2 months by preparing ourselves with all these things. So I think I would say we've not faced much challenge, because we were pretty much ready for this. Initially only we had our systems and capabilities. Key was how we can manage all this moratorium, ECLGS, back-to-back things, which were very, very critical for any bank and NBFC to deliver, and they were time bound. You don't have time till 3 months, 6 months. You have to deliver fast. So if you are delayed, if you are not able to deliver under all these challenges, I think your operations person is also sitting at home, your risk person is also sitting at home. You have to design everything in such a manner, and I think all these things were handled in a beautiful manner by us in the organizations together as a team.
Very well said. Kunal, what's your thought on this? Is Kunal back? I think we lost Kunal, right? Kunal,
yeah, hi. Yeah, I think I was on mute, so
sure.
I'm just unmuted it. So thank you for allowing me to share my views. This is obviously more on personal views than the views of my company, which are Elets Finance. So I will basically the way our customer thing is concerned, most of our customers are new to credit customers, and they are primarily from lower income strata side of it. They will be new in terms of using the vehicle maybe for the first time, but being a part of the industry. So one of the key challenges for us was how we communicate to them so that it is understandable from their perspective. How the challenges around moratorium period is clear to them, what is in it for them, and how much additional interest is what they will be incurring. So one of the key challenge for us was how we communicate transparently to our customer base. As given a big challenge of them being new to credit. So that was the first one where, what we tried and do is, we as a company, we operate still in a very traditional manner where our sales team is only responsible for doing the collections of, whatever they have sold. So in our company, we do not have any sales officer. We call somebody as a business officer. So he's a business representative who will do a lot of relationship based selling as well as collection from the same customer. So when he is communicating to the to a customer, it's very clear to the customer that while he has sold the thing, he is also servicing me and he is also helping me in terms of understanding the financial side of it. So therefore, what we try to do, we try to encash upon this particular opportunity by basically popularizing our mobile application, which we call as HLF Connect. And using that mobile application, now the communication to the customers were basically done through those mobile applications. And even his basic customer servicing requirements like the statement of account or basically his NOC request and everything was all feeded in as a request requirement in the mobile app, so that he is not supposed to call anybody, and even if he needs anything he can log in over there. Additionally, one big challenge that we faced was that the sales were not happening because if the public infrastructure or public transportation infrastructure, to be precise, was not working. So the three-wheeler and some of the other transportation vehicles that we finance, were not going on. So therefore, what we tried to do at that point in time is to support customers in terms of making his collections available from the same mobile application. So that is where we actually saw that our mobile application penetration grew 3.5x in this period of time. And at the same time, our incoming call center, the incoming calls in the call center, they also reduced considerably. So while infrastructure challenge like what Dominic and Anil covered earlier were faced by us as well, but we somehow thought that marketing of this mobile application and making them popular through the business guys will try and support us in terms of managing the customer relationship, and that's what we try to do, and then with God's grace it worked for us.
Yeah, thanks, Kunal. I think COVID-19 had been a biggest digital enabler for everyone. And I think all of us have really come out very successful in this thing. And going forward, like everyone is talking about new normal. Will it be a new normal? Right now, still we are seeing that we are still more protective about our employees, ensuring that we are taking utmost precautions, asking our every employee to take a precaution, because see, most of our staff is going to be on the field. We need to protect them. We need to ensure their health. So while doing this, at the same time, we need to propagate how we can make it more digital, create a more digital journey, and ensure that, because whole thing is, I'm not sure whether will we again come back to the old normalcy again, and will be a completely a new normal that we are going to see. So looking at this, how this new normal is going to accelerate the digitization across the NBFC sector, which I already, few of you have already demonstrated how you already moved towards that journey. But which technologies that you are ensuring that business continuity for the NBFCs going forward? So if you can throw some light on this, maybe I can ask Anil to start first, then let Dominic take over from there.
Yeah, Deepak. So as the old saying goes, like every adversity brings an opportunity with it. So this is the second time like we are seeing in our sector, like basically we are a microfinance, NBFC microfinance organization where we operate in deep rural. So before demonetization, like we used to do disbursements through cash, and demonetization it forced the entire sector to do cashless disbursement directly onto their bank account. And now this COVID, like this after like almost 3 years, this has brought up another challenge for us. Like we are now for cashless collections. So not only our institution, but many other institutions also, they have piloted this cashless collections, and we also did pilots with multiple vendors in different areas. So this cashless collections is going to be probably the new norm, and this is what like we expect it to continue. Like it should not be like just during this time, like it picked up and then later on again people go back to their thing. We don't hope that. At least we expect like a significant amount of our collections to be cashless, and as many people get into cashless, that becomes even more viable to us from a financial perspective as well. So this is one which I see in the new normal. And the second thing is like we are yet to get back to our normal collections. So still like we are a 90 plus, we need to still engage, and even some of the people in the ground, like they are still yet to pay back. So that collections is another challenge, and unless we have collections, it becomes very difficult for us to sustain and grow in this industry. So what all technologies, what all support, IT support is required to bring back those collections. We are doing that. And coming to the new normal, like this cloud adoption has now become a new norm. Like it is no longer a choice. So it is a must, and organizations have realized that, and most of the management, they will now realize IT as not only a cost center, but they will realize us as a like a business enabler, and they do realize us as a people engagement tool and risk mitigator as well. So considering all this, this I think will be the new norm, along with cloud and related technologies like audio bridges, Google Hangouts or Zoom or anything, any technology which help us stay connected. These will continue, like these will still continue going forward.
Dominic?
So this is what my take.
Yeah. Deepak sir, in addition to Anil's thing, I mean, little bit, I take the privilege to say that, Art Housing Finance started off as a digital company right from the day one, the time it was incorporated. So we have an app which basically where we acquire the customer, which is basically a lead generation up to sanction process. So right from your civil, this one, then your PAN verification, everything is done at the doorstep of the customer. So that was one of the advantage for us during the COVID time, which helped us to do, though it was not much of sales. But the challenges what we faced was more of from the collection perspective, because the kind of customers we have are all tier 3, tier 4 city customers, and with moratorium coming up in the picture, getting the collection, there are some customers who were willing to pay, but there was no option for them to pay for it. So it was for us a challenge to get those digital payments enabled on the system, so that these customers can make the payments without much of a hurdle for us. Second thing is when you look at digitization, this COVID from March, I can say till date, has given us lot of things to automate things. When I look at my back office operations, many of my things are getting operated. Even today, my call center is hosted on the cloud. Like 2 months back, we hosted the call center also on the cloud. So today, the dependency on the physical infrastructure, dependency on the branch is not a requirement for us in the new normal. It is basically you can work from anywhere, but in a very secured environment and, as per the business requirements. Yes, sales is always at the back foot because of the various reasons, which are new business plus coming up, we may again kick off with the sales. But when you come to collection, which is a major chunk of money which comes into us, survival of the company is today is more from how good we are at collection. So how are you going to digitize it? How best you can convince the customer and get, though we do a complete digitization, given them a digital payment options, multiple options, UPI options and all that, customers still have that kind of tendency, they need the physical presence. So there are challenges which we are facing. It's both brick and mortar process as well as the digitization process. Plus, back office automation is one which is taken on the top seat. Call center solutions are being moved onto the cloud. People can access my call center, so the customer service is not being affected at any point of time. Any kind of queries have been addressed, even at the lowest of bandwidth of your hotspot of your mobile phone. Okay, which is really we see during this COVID time, when you look at the infrastructure, the internet bandwidth or the data usage has grown up And I can say the ISPs have supported us in all the ways. And third thing is, we should never backseat on our security features. That's very important. Security has also played a major role. Like, you talk about DLP, you talk about VPN, you talk about from BOYTP, which are all at the backseat pre-COVID. Nobody were approving it. They were sitting and Dominic IT is always alive. Now today, they force us to see that we secure the environment, because when I'm working at home, I don't know the broadband connectivity, what I have, how secure it is. Whatever I do, multiple passwords, encryption, and all those things. So my data is secured, and dependency on the data, physical data center, is gradually vanishing. The cloud is coming into picture. Cloud is playing a major role. Again, when you see cloud coming into major role, we got to see the pros and cons of the cloud, whether what kind of cloud we are hosting, hybrid, private cloud, and the public cloud, the kind of applications. Then back office, when you look at the smallest application, for example, if I have to process a vendor's bill to my finance, I need to use people. But today we have automated everything in such a way that even the vendor's payment is automatically credited in his bank account. I mean, we have done a lot of things during this COVID, and I really feel proud to say my team, though we were at a remote locations working on the VC, and VCs played a very major role. Today, all the board meetings are done digitally. It is all VC. Today, I don't have any board member coming into any place. So somewhere I see the cost coming down, physical structure and the cost, physical infrastructure cost, and the cost of up and down of the board member traveling to our place. It is all come down, so there's a major cost cutting which has come down, and digital has played a major role. And when I say digitization, this is going to be a new normal, sir. That nobody can change it, and we got to accept it, and we will keep going. That's my take.
Thanks, Dominic. Kaushik, your views, please.
Yeah, Deepak. So I think as covered by Dominic and others. So immediately, I think in the month of April, we as a company, what we decided that I think this type of disruption, which is an unprecedented event for everyone across the globe, how should we be ready for such type of events in future? So I think we formed a core team. We formed a separate team that we need to think this around, though we have a lot of digital capabilities, but how should we handle this in future? And I think what we designed and what we formulated as a plan was that how we can digitize each and every process which was currently done, whether it was done manually or semi-automated manner, how we can move that in an automated manner. That was the thinking, and that was the brainstorming which was done by the core team, where team members from different departments, like starting from risk, product, finance, business, everyone brainstormed. And I think the key ideas which came, and obviously we implemented a lot of them, and we are in process of execution of some of the ideas also, as how we can onboard a customer, how we can prepare a paperless journey. So that in a current type of environment, obviously in your small ticket loans like personal loans or consumer loans, you already have those paperless journeys. But what about in bigger ticket size loans like housing loans or loan against property or business loans, where we all know still a lot of companies are in midway, they are not completely digital, they are in the midway. How we can do and have a digital onboarding, digital decisioning, automated dispersal, fulfillment process by using different tools, starting from a video KYC to a video PD to a e-NASH, e-mandate, and using data science analytics in a proper manner. There are so good tools currently in the market, which are like a lot of organizations can still have a practice of getting FI done to check the stability of the customer. Can we use certain vendors which can replicate that? There are very good tools given by certain bureaus, certain other companies, which tell us the socio-economic score, which tell us the resident stability index of that area, and multiple other tools. So I think that is what the brainstorming was done, how we can reduce customer touch points, Why, if credit manager have to visit physically, can he do a video PD? Is there any other surrogate which is available? How we can further scale up with scorecard based underwriting? I think using AI ML based scorecards and moving towards objective underwriting rather than a scorecard based underwriting, so that this brings more scale, this brings more speed, this is paperless, and along with different APIs currently available, we know a lot of neobanks and lot of different companies are there, and we are in an era of APIs where we can use those APIs, just plug and play, and you have to develop your platforms in such a manner that if you can use that API, you are there. I think that is what the discussion was, and similarly, then moving towards digital collections, what my other friends have told, how we can onboard different payment gateways, how we can collect digitally, how we can prepare a platform for the customers rather than they calling to our call center. They can come to our app or a portal and download their SOAs, statement of accounts, repayment schedules, any query. So I think that was the objective, where in each and every process, starting from onboarding till the entire servicing of the customer until the collections, is with us. How we can digitize and automate each and everything, starting from onboarding, servicing, collections, underwriting, reversal, fulfillment. That is what I think, according to me also, I think that is the journey which every organization has to travel. I think a lot of people were thinking about this. According to me, this pandemic has preponed this by at least 2 to 3 years. Because anyways, everyone was thinking in same direction. But I think now this has become a compulsion for everyone to think in this direction.
That's a great answer. Thanks, Kaushik. Kunal, your thoughts on this before I summarize?
Yeah, I think from our perspective, it's not very different from what the three other co-panelists have covered. Only difference being, you will hear a risk officer's flavor in this entire conversation. That what we were trying to do is do not go whole hog into digital mode in the first go, and go in a way where the customer's requirement is also fulfilled. So, for example, what I'm trying to say is that if I have a auto rickshaw driver, I know that he will not be able to digitally fulfill the requirement of a auto rickshaw loan procurement. So I know there are certain things that I can only limit myself to from a procurement side. So the areas where a few seconds back Kaushik mentioned, a video KYC was enabled for him, because there I understood that we can still do a bit of digital initiative with these kind of customers. But at the same time, when it came to a two-wheeler financing, I saw a lot of my customers are salaried profile, and I knew they are in a better the awareness of digital tools is far more better with them. So the digital tool implementation was done in that strata of customer base. But when it came to the other products, we limited ourselves to still go into a mix of traditional and digital platform. And when it comes to the back office implementation, we try to use digital risk assessment methodologies like what Kaushik mentioned, ML based, machine learning based scoring mechanisms, so that the assessments or the reliability only on human judgment can somehow be replicated through a digital mode, where we also back these judgments with the risk-based data assessments. And the challenge obviously over there is to continue to feed this kind of a database with more intelligent information which is available. Luckily,
Looks like there's some disruption, Anil.
Lot of APIs are available
Kunal, looks like there's some disruption, Kunal, at your
Today's,
end.
so you can.
Kunal, there is some disruption in the line. Your voice is breaking.
Anyway, there's a next question which is completely towards Kunal and Kaushik. So let me just, I think this was a wonderful answer given by 4 of you, the great discussion we had. Beautiful part is Anil just reminded us of the first digital transformation enabler, that was demonetization. And then now it's COVID-19. Dominic brought in another good point of cost reduction. Everyone is re-looking at the cost per branch, how we can minimize the cost, and how we can leverage on the next digital platforms to reach out to the more number of customers. And Kaushik, the beauty that you brought in is basically thinking about the future, bringing in the future, and how you are already started looking at how the solutions will be futuristic and how we can get to the more customers and also assess them as a retail credit officer. That's another point which you brought in with the analytics, machine learning into picture. And then of course Kunal, from his hat of chief risk officer, brought in the point of how we can make it, in short, physical versus digital, and also how with video KYC knowledge enabling. I think fantastic answer, a great discussion we had. Now, going forward, like while no one can say how long this crisis will last, what we found on the other side will not look like the normal of recent years. The new normal will be shaped by a confluence of powerful forces, some arising directly from the financial crisis and some that were at work long before it began. Obviously, there will be significantly less financial leverage in the system, and business models that rely on high leverage will suffer reduced returns. Now, this is which bringing us the more challenge or a risk to us, where we don't know whether what is the real productivity and what are the real productivity gains, and what is the huge risk that is getting into this. This we absolutely cannot neglect. So, with that in mind, my next question is basically what all risks are identified and anticipated in this new normal, and how organizations should act upon them. Is there an increased risk of cyber frauds with rising tech dependency, which we little bit we touched upon? And also, is there a pressure on us for the cyber security budget during the uncertain times? And this definitely I will ask Kunal to start on this, and then Kaushik to take over from Kunal.
Yeah, I'm sorry, I was able to got disconnected in the last conversation. So as far as the risks are concerned, that's a pretty important area, and one of the key risks, if we start basis the journey, is to have the right kind of infrastructure for us to allow the customer data to be shared outside with our people who were not earlier connected with us through a digital form. So if we are enabling users who are on mobile network or who are basically on their own personal broadband networks, there has to be those controls which are put in place, and to somehow manage the risk of data leakage. Because in the initial part of the conversation, Dominic mentioned that what information is going out, and by using what medium. We don't control the medium, but we can control at least the data which is going out. So therefore the information which was shared with people was with a very very limited and specific access. So if it's for a collection journey, the information which was shared was only related to the requirement of what is the name of the customer product, and maybe what is the EMI amount, rather than sharing the entire details about the customer. And at the same time, we being on one common platform as an organization, so we do not have multiple platforms across multiple functions in our business. That is one unique and one of the biggest asset that we have in the organization, that we have one platform where the entire journey from employee onboarding to the customer onboarding and collections, and the entire journey is on finance. Everything is on one common platform, and which is a homegrown platform. So therefore, we had a big risk of all our information being at one platform, but at the same time, the control was that this platform was completely hosted on our data center, and with a real-time backup on a parallel distinct data center. So therefore the second risk was one was the data leakage, and the second biggest risk was the availability of information, because like a few seconds back, my conversation with you guys got interrupted because of a low bandwidth issue at my end. Imagine when I'm sitting in a metropolitan city in the country, this is what is happening. And now imagine, how the infrastructure sometimes gives challenges in the remote parts of the country. But at the same time, therefore, availability of information was something that we didn't want to compromise. So therefore, adequate measures were taken so that people do not, face productivity challenge because of non-availability of information. The third challenge is that while you want to go whole hog in terms of providing, giving information and making information available to people, the other aspect was the kind of malware attacks or other ransomware attacks which continue to increase because of additional ports being opened, because now people were able to access information as well. So somewhere down the line, that was an additional challenge or risk that we faced, and there was more stringent monitoring as well as more thing which was controls which are put around how the systems are thoroughly updated, the antivirus solutions were updated. Also, how the entire penetration testings were reconducted, and vulnerability assessments were done in a more frequent manner by plugging in, whatever were the outcomes, so that we feel more secure. And at the same time, the data which has been coming to us through these ports are kept in a more secure manner. Because traditionally, all this information was coming in a physical form. Now, everything is traveling through digital mode. So, therefore, adequate measures were taken to mitigate those risks. So, just to summarize, one thing, which is basically availability of information. The second is protection of information, and the third one being, that access of information. Who needs to get what kind of access?
That's great. Kaushik had little bit of bandwidth issue, so he's just logging in back again. Till the time, Dominic, would you like to take this question?
Yeah, I would like to add certain things to Kunal, what he added. From the CRO point of view, we had a lot of things which as CTO or head of IT normally adds. So my only thing will be during this time, the cyber frauds are at a very high increasing rate. Okay, now how are you going to control it? Controlling means it's not like a policing, it's basically how your main three things I depend on, which normally is the periodic audits, vulnerability and penetration test, and a secured communication and role-based access to every user. And second thing, the last thing, last and the least one, what we have to add is how secure is your endpoint devices. For example, the mobile devices or your laptops, or the BOYD kind of concepts today we are using, how secure it is. So when you're trying to bring in these kind of security measures, we may try to control cyber frauds to certain level. I can say up to 60 to 70%, but another 30% you're always open. Because all this happen, these are all unpredicted ones which happen. So overnight you cannot keep blocking the ports. You can do to certain limits. So BOYD plays a major role. Your MDN plays a major role than your audits, and fine-tuning of your IT policies. That is very, very important in this sector, because work from home, and then when you say work from home and new normal, it's almost a similar way. But because when you talk about the digitization, you're exposing your complete technology to the outer world where you don't know how what control it is. It's not like a corporate network, you have limited access to everything. It is, you're on an open network. So how are you going to secure it? Who's going to use what? What kind of data is he going to carry? If he's carrying the data, who's auditing it? How is the maker and checker concept? That's very important, maker and checker concept. And the responsibility of every person involved in this, because security, cyber crimes is not only limited to certain individuals. It is a responsibility of every individual, right from your physical and the logical, right from your security guard. It goes up to everyone. So how are you going to secure it? As a head of IT and where I handle security as also, which is saying, how are you going to secure your things? IT policy is important, your BOYD concept, MDN policies, then fine-tuning your existing network. This COVID time has made us your technology, your backup, your BCP, how secure all this is. So we have done a lot of drills, and so from today, if you consider this situation, tomorrow if you can even face a situation worse than this also. So, but again, you got to keep upgrading yourself. You got to keep, and at the same time, I would the management is also has been you can say the management has come to know that IT plays a major role. Okay, we have to fund them in all the ways. You talk about the board approvals, you talk about the financial approvals. I see just things coming up in a very fast way. Yes, whatever you do, end of the day, there's always a leakage of 10 to 20%, which nobody can do anything. But how we are going to overcome this, how we are going to secure it back, that's very important for us.
Great, thanks, Dominic. I think Kaushik is back. I think would like to hear reviews from Kaushik on this.
Yeah, Deepak. So I think Deepak, what I think the key risks in this type of environment, I think obviously one is your data theft. I think as we expose more towards the digital type of environment, we have to be very, very careful about data, because everyone is saying digital database underwriting, it is not so easy. I must tell you, it is not so easy. I will give you a very, very basic example. In underwriting, everyone is saying, yes, we have to be digital. See, key challenge in this environment is you have to think about your customer journey in such a manner that there is no customer identification problems. A customer X is applying with customer Y KYC and he's taking the loan. And when our collections team is going and tracing that customer, you can't find out that customer at that address. So I think you have to be very careful, and this is why your customer journeys, your SOPs, your roles and responsibilities have to be designed in such a manner. Your operational risk framework has to be designed in such a manner that each and every incident has to be defined over there, so that there is a proper maker and checker concept of each and everything. I think that is what we have to follow. And being a risk officers, we have to be very, very careful about that. Similarly, there are a lot of lot of smart tools also available. How you can measure the lat long of the customer who is applying, which address he is applying. Do we have any OTP based authentication services? I think you have to be very, very careful about this customer identification, according to me. That's the key point. Second, obviously, is the data theft. As everyone is working remotely from their house, I think everyone is having access to a lot of critical data, which organizations having. Do we have some good application softwares which can easily detect if anyone is sending any mail outside or might be transferring certain files? There are a lot of good softwares also available. So I think we need to be very, very careful in regards to that also. So in my view, I think operational risk plays a very, very important role. Your internal audit departments have to be really, really strong. Digital is easy to say, but once it's go burst, it is very difficult to catch hold of it. You have to be on top of it, whether it is your any internal audit or might be hindsighting frameworks should be designed, or SOPs should be designed in such a manner that you are always on top of it. You are mirroring each and everything. It should not be a reactive type of thing that after 6 months, once you know that out of 10,000 customers you have funded, you're not able to trace 1,000 customers because your customer journey was defective. So I think we have to be alert in designing all different things. What I can tell, whether it is SOPs, operational risk frameworks, customer journeys, roles, responsibility in such a manner that we take care of all these risks also, which I think we are exposing ourselves to. More we are moving towards all these tools. Digital.
Great. Thanks, Kaushik. Anil, your views?
Yeah. So, as Kaushik mentioned, definitely, we need to establish identity of customer beyond doubt. So that is the number one criteria for us to stay in this business. So at Vaya, I would like to share a couple of best practices what we follow. So one is we do take customers geo coordinates. So when we capture customers photograph at their premises, we do capture the geo coordinates and we see whether the photograph is taken, customer is present at that particular geolocation or not. Geo coordinates we use, and then we also use other techniques whatever the identities customer provide, we do verify them, we do validate them. For example, if customer provides voter ID, we use voter identification authentication tools. If customer provides PAN card, we use those validation tools to identify that the KYC document provided by customer is genuine. So we make use of API integrations for doing these activities. And also, apart from this, we do also do penny dropping onto their customer's bank account before actually transferring money. And in that process, we do get details from bank as well. We get the name of the customer as per bank records, and then the account number and IFSC code. So these details, again, we do triangulation, information triangulation, and we have a process wherein we eyeball every application. We developed a very simple single screen application wherein all the KYC related information of customer is displayed in a single screen, and this gets eyeballed and approved before it goes for dispersal. So I cannot agree more. We need to identify our customer beyond doubt. So this is one. And then with this new normal, working remotely and then digitization, cloud adoption, it brings in a lot of other challenges. So as our friends earlier mentioned, we do conduct VAPT, vulnerability assessments and penetration testings regularly to assess how strong our networks are and how easy is it for anyone to penetrate into our network. So these tests are mandatory, I would say. And we need to upgrade our security patches, upgrading firmware in our routers, switches, and firewalls. This is again very important because unless we upgrade this firmware, we will not be getting the shield against latest threats. So this, and also we apply content filter services, and this provides if there might be some functions within your organization which require access to internet, unrestricted access, and for some others you may want to restrict access. So this content filter service also we do use, and we recommend others to make advantage of that as well. And most importantly, though we are on cloud, that doesn't mean we are always secure. We need to take backups and keep these backups at an alternate site, not the primary site where our application is hosted. And we need to test that regularly. So regularly, I mean to say at least once in a year or once in 6 months, we need to test that. So in our organization, we bring down the application completely. We shut down the database, and then we try to recover from that point. So we measure, there are some things called as RTO and RPO. So we see whether these RTOs and RPOs are met or not. And this also gives us a confidence that yes, in case any eventuality, though we take a lot of precautions, still very big networks like Facebooks and Googles also sometimes they got hacked. So we are not immune from them. But if at all we get into such an eventuality, then how soon can we recover from that? So these backups will help us recover from that. So this is very essential that you take backups and maintain them in an alternate location. So,
great, thanks. And I think another great conversation we had, and everyone talked out of their own experiences, a rich experience, and definitely with the rich knowledge, and that kind of knowledge that is getting disseminated here is amazing. Thank you so much, everyone. Before I summarize the whole interaction, I thought, Kaushik, let me add to your point. You said it right, customer identification. Right now in this pandemic, what we are seeing is skip trace cases are increasing. That's another thing which we saw, because some of the customers who are on the rentals, suddenly they're moving out of that place. So that's another area which has come across as an additional thing where we know that till this point we could contact the customer, now suddenly he is not there. So that's another point which we saw. So there are the additional things which are coming up. I think we had a great discussion so far. Time is running out, so let me just summarize. Unless any one of you wanted to add something, please go ahead.
Yeah, I just want to say one point, very small one. Risk management as a process, has 5 legs: identify, measure, manage, monitor, and report. Whether we are in digital age, whether we are in the orthodox way of doing things, I think the most important stage to a risk management process always remains to be identification of risks. So, like for some of our colleagues over here, they would be monitoring their systems, their processes, their various things which are running through various key risk indicators. There is another point which one of us mentioned, that risk is something which will always be with you, because we all are in the finance industry, where we are in the business of taking risks. It is important to basically note down all those events which are causing those risks, and then maybe do an RCA, which is a root cause analysis of why that event has happened. There is no point panicking with the risk. There are certain risks which are going to be high on priority, certain risks which are going to be low on priority, but you're always going to be surrounded, whether it's personal life or professional life, with risk. So my last take on this is that whatever said and done, we all should emphasize on the identification of risk, whether through monitoring the KRIs or whether through recording the risk events, and then going into the root cause of analyzing those risks.
Thank you so much, Kunal, for summarizing on my behalf. Thank you so much. See, the thing is, what we call it, we are not in the business of lending, but we are in the business of managing risk. That's what it comes to, right? And I think that it's summarized very well. And the key pointers, just takeaway of this entire discussion, was basically digitization, digital process with additional controls, cloud adoption. Then we talked about the SOPs. We talked about, from futuristic point of view, how we can take care of the endpoints, securing our endpoints, and ensuring that our systems, our endpoints are more secured, with ensuring that with continuous testing from the endpoints point of view, and upgrading of our security features, ongoing upgradation, and of course the key, another best practices, another point which was mentioned there, and ensuring how strong your KYCs are. So that's additional thing which is coming up with this current thing. And of course, another point everyone mentioned is like data loss prevention, how we avoid the data theft and how we can improve on your DLP processes. I think this is what I would like to summarize. Thank you so much for all your inputs. We had a great conversation. And thank you so much once again. Let's be connected. We have a group anyway created. Yeah, thank you so much.
Thank you so much, the eminent panel and the moderator, Mr. Deepak, for this insightful discussion. And now we'll be moving on to the networking break. I request all the delegates to kindly network with each other in the networking lounge, and also please visit the expo. Let's meet after the break. Thank you.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना एक रुतबा प्राप्त किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं। और ये मेरा साथ मैं हमेशा कहता आया हूँ, आईटी प्लस आईटी इज इक्वल टू आईटी। इंफॉर्मेशन टेक्नोलॉजी प्लस इंडियन टैलेंट इज इक्वल टू इंडिया टुमारो।
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection regulations, and aren't addressing new hacker tactics, leaving organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by an overburdened staff will never meet today's compliance and security challenges. An easier and unified approach to discover, protect, and control sensitive data everywhere is the only pragmatic way to protect your organizations at the rate and scale required by today's risks and transformation initiatives. Data security and compliance starts with finding your exposed sensitive data before hackers and auditors. This data can be in many forms: files, databases, and big data, and can rest across storage on your premises, in clouds, and across backups. Once you've identified databases and file systems that contain sensitive data, you can then apply data-centric protection, such as encryption, granular access controls, and tokenization. For encryption and tokenization to successfully secure sensitive data, the cryptographic keys themselves must be secured, managed, and controlled by your organization. Finally, virtually every data security regulation and mandate requires organizations to be able to monitor, detect, control, and report on authorized and unauthorized access to data and encryption keys. The CipherTrust Data Security Platform is an integrated suite of data-centric security products and solutions that unify data discovery, protection, and control in one solution. Thales has pushed the innovation envelope to remove complexity from deploying data security, accelerate time to compliance, and secure cloud migrations. The platform provides powerful tools to Discover and classify the data that your organization should be protecting. Protect against external threats and insider abuse with robust encryption, granular access controls, and tokenization strategies. Control your data wherever it is stored with strong centralized key management. The many solutions available on the Cypher Trust Data Security Platform can be deployed individually or in combination, so you can secure your organization's most sensitive data without increasing deployment and operations complexity. This results in less resources dedicated to data security operations, ubiquitous compliance controls, and significantly less risk across your business. You can rely on Thales to help you discover, protect, and control your organization's most sensitive data, wherever it resides. To learn more, visit Thales' Cypher Trust Data Security Platform.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना एक रुतबा खड़ा किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं और ये मेरा साथ मैं हमेशा कहता आया हूँ, IT plus IT is equal to IT. Information technology plus Indian talent is equal to.
Hello all, I welcome all of you after this short break. And now we move on to the next panel discussion. And the topic of this discussion is green shoots, lending opportunities beyond pandemic. And the panel of this panel discussion is Mr. Bhavin Patel, co-founder and chief executive officer of Lending Club, Mr. Bama Balakrishnan, chief financial officer of Northern Arc Capital, Mr. Akshay Malhotra, co-founder and chief executive officer of Early Salary, and Mr. Mayank Kushwaha, founder and chief operating officer of India Lens. And the moderator for this session is Mr. Neerav Choksi, co-founder and chief executive officer of Credible. So we look forward for a wonderful discussion, and I request Mr. Neerav to please take over from here and start this panel discussion.
Hi, everyone. Thank you for participating in today's panel. My name is Neerav Choksi, and I'm the co-founder and CEO of Credible. Credible is a supply chain financing focused fintech platform company based out of Mumbai. Today, we are going to focus on talking about lending beyond the pandemic. And as we all know, COVID has been a significant black swan event, and industries have been deeply affected. In light of all the changes that have happened over the last 6 months, the NBFC sector probably has seen a huge up and down. So we are here to discuss the impact of COVID on the lending sector, especially on fintech companies and new age NBFCs. So before we start, why don't I ask all of you to introduce yourself, and maybe Mayank, you want to start first?
Sure. Thanks, Neerav. Thanks, guys, for having me here. So, hi, guys. I am Mayank. I am one of the founders of India Lens. India Lens is a consumer lending platform that focuses on providing free credit reports to customers on the one end, and on the other end, we partner with different financial institutions, NBFCs, and banks to sort of come up with pre-qualified, pre-approved programs, and to be able to offer these to our existing customer base, which is largely the consumers that we've acquired for free credit reports.
Great, thanks, Mayank. Akshay?
Thanks, Neerav. Hi, my name is Akshay Malhotra. I'm co-founder and CEO of Early Salary. We're a 5-year-old fintech startup which provides credit to salaried professionals. I think to our strength, we're about real-time decisioning, onboarding customers within a few seconds. I think pre-COVID and pre-pandemic, we were doing close to 130 to 150 crores a month. I think currently we are trending at, let's say, 85 to 90 crores a month. So things are picking up. But of course, consumer lending will go through its own struggle of growth cycles, etc. But I think markets are interesting today.
Right. Thanks, Akshay. Bhavin?
Hi, everyone. I'm Bhavin Patel, co-founder and CEO of Lending Club. We are a pure play P2P lending platform, managing connection between the individual investor in the country to individual borrowers across the country. So earlier we used to run the business in 7 states. Recently, after looking at good borrower repayment tracks, we have expanded our pan-India operations, and we are seeing a huge participation of both the kind of users across country. So it's a pure play tech platform. If you look at the numbers and the how it has fared during the pandemic, the last month we could come back to the same level what we used to disburse through our platform during pre-pandemic time period, and we foresee that the way recovery is bouncing back, next 3 to 6 months are going to be really good for us.
Excellent. Thank you, Bhavin. And last but not the least, Bama.
Thanks, Neerav. Hi, everyone. I'm Bama. I'm the COO of Northern Arc Capital, a decade-old institution with a mission of enabling access to finance for the underserved. We do this primarily by enabling access to debt capital markets for high-quality financial institutions. It's wonderful to see some of our clients on this panel as well. We work in 6 major sectors, primarily microfinance, SBL, vehicle finance, agri, consumer, and affordable housing finance. We've raised close to about $10 billion for our clients across these sectors over time, with a very strong capital markets focus.
Excellent. Thank you, Mama. So thank you all of you for taking time out and being active. Why don't we open this question up to the entire panel so that all of you can contribute to this. The impact of COVID on both retail and corporate lending has been significant. There have been huge disruptions in supply chain, loss of income, operational shutdowns, and all of that has caused NBFCs and banks to rethink their entire business strategy and their long-term vision. In light of all of this, what do you think are your current strategic priorities over the next 3 to 6 months, and how do you see them panning out? Maybe Akshay, you want to start first?
Yeah, so I think it's an interesting time period. I think, fintechs and NBFCs and banks are very interesting, right? We went through 2 NBFC crises, 1 banking crisis before COVID. So we are quite hardened as players would be. On the other hand, we had to gear up for 2 things in pandemic. One was the risk shock which happened, because there would be a fair amount of customers who will have loss of pays, reduction in pays, etc., and how to manage that risk shock. The second risk shock was coming because of the moratorium which came in, where how does our portfolio behave, can we collect back, and the efficiency metrics fell apart. If I look at players like us, at least for early salary, I think we were just in the double digit when it started off in moratorium requests, but I've almost seen 70% of our customers still paying during the moratorium period itself, which meant that the customer base that we attracted till date was much better in quality, and we didn't have to worry about will this impact negatively to too much of an extent. So if I look at coming out of the pandemic, while August month we saw us having some ability to lend again, but in the month of September we could actually see a very strong comeback, both at a portfolio level. We are seeing our portfolios coming back to better than pre-COVID numbers. We had raised our risk bars, but we are seeing more and more comfort that we can lend to the customer base that we attract today, and we continue to hold our older customer base, so whenever they want more money, they can borrow. The second part has been that this is the opportunity that we can really come back and stand up as a much stronger entity and an industry versus traditional players. So players like us have decided we are going multiple product lines. We have now introduced from 3 months up to 3-year personal loans, which means that if we get a customer, we can cater to all his requirements. We were known to do 70,000-80,000 loans a month. They were small ticket. As we grow in larger ticket size, we'll start playing the value game and become an AUM business. The second part is we need to have multiple products to retain the customer for even longer window. I think the pandemic taught us one thing, that we actually have a much superior quality customers than most traditional players or even others in our category, which means that we should have more products to retain him. So we have started doing checkout finance where our customers can transact on Flipkart, Amazon, and payment gateways, etc. In fact, we are just on the verge tomorrow to launch our version of a payments card with RuPay, which we believe now we have a holistic offering. Any unsecured product for a salaried customer, we have the product line. So as we add, let's say 15 to 20,000 customers each month to our pie, we can actually build a large AUM base underneath this entire growth acquisition. And we believe the next 12 months could actually help us grow 5 to 6 times.
Awesome. Mayank, how do you see this panning out?
Actually, to Akshay's point, right, I wanted to add some more color. See, the thing is, being a marketplace, we actually get to see a variety of lenders in the back end, right? So we've actually seen some that were entirely focused on self-employed customers. When I'm talking about self-employed, I'm still talking personal loans to self-employed individuals. And then there was this entire set of NBFCs or lenders that were focusing on very small ticket loans, right? 5, 10, 15,000 rupees. And there were obviously these large ticket lenders, the typical large NBFCs that are doing about 2 lakh, 3 lakh rupee ticket size on average. The impact of the moratorium and the pandemic and the job losses because of that, right, has been massive on the self-employed sector. in the way we see it, right? And self-employed lending hasn't come back on our platform, right, with all of our lenders. And I'm still talking personal loans, but self-employed personal loans haven't come back. The small ticket loans, right, to Akshay's point as well, I think he's focused on those value loans. What has happened is a lot of those people who've lost jobs are the people with low salaries, right? And people, especially people who migrated back, right, who had access to, those 5,000-10,000 rupee loans for all this while, they've all gone back. And so suddenly that segment is completely gone. And we are seeing more and more players, right, across the value chain looking at larger ticket loans, right? And then typically when one starts looking at larger ticket loans, they enter into that same segment, where let's say the HDFCs and the big banks are already playing, and let's say large NBFCs are also playing. So we are seeing a clear shift. Now what's happened, right? Most of the lending seems to be back in terms of volume, but not in terms of numbers. And that, I think, is where the significant shift is, that even some of the smaller lenders are focusing on large ticket loans, longer term loans to people, to employees that have not lost their jobs and have continued their jobs, right? And obviously are, like he said, I think hardened, even as customers, they're hardened because they've gone through this crisis. But the smaller ticket loans and self-employed loans seem to have disappeared. Only now have the conversation started back about some of these guys looking to lend in those segments. And I'd love to hear other people's views on these segments, specifically the low ticket and the self-employed segments.
Well, Mayank, in view of all of this, what are your strategic priorities? How are you relooking at your business?
See, what we've always done, right, I think is because of our large base, we obviously try to look for supply for different segments, right? And so that continues. What we are doing, and I think the way this the ecosystem has changed, I think for us specifically, is that largely the ecosystem was DSA driven for large banks, right? And so what we are seeing is all of the DSA, because people are not meeting anyone, that DSA ecosystem is actually completely gone, right? And banks are trying to replace that with platforms like ours. So I think for us, strategic priority is to try and do more business with some of our existing partners, which are some of these large banks, and try and get a much bigger share of the pie there.
Got it. Understood. Bama, you work very closely with both new age and traditional NBFCs and financial institutions. How do you see your shift in terms of business priorities? Do you want to continue focusing on that sector? Are you looking to diversify that sector? How does it work for Northern Arc today?
Very good question, Nirav. So it's interesting that whenever there is a significant sort of crisis in the sector, it actually throws up more opportunities as we see it for Northern Arc to actually work with a lot of these partners. And we do this in a few different ways. And honestly, COVID-19 was not significantly different from that perspective. So the way we approached this was to say that reinforcing our belief and fundamental risk appetite in these underlying sectors. So I would completely echo, Akshay and Mayank's comments on the fact that we believe institutions in these sectors are fundamentally resilient. So they've seen multiple crises, and even the end customers are resilient. So we continue to kind of risk underwrite in these segments. We don't see any sense of a pullback from there. But as with all prudent lending institutions, we continue to be, I would say, more selective about who we work with, right? So our underwriting guidelines have clearly tightened. We're also looking through with the partners to see where have they tightened their underwriting norms. And for instance, we've heard some of what Mayank was talking about, a greater shift away from new to credit customers, which does result in, I would say, a higher degree of exclusion, but be a necessary consequence of the current crisis. The other piece where we've actually spent a significant amount of our time is really mobilizing capital towards some of these sectors to complement what we're doing from our own balance sheet and what other, I would say, more experienced investors are doing in these segments. So for instance, bringing in DFI funding, bringing in a little more impact funding, where especially some of the underlying sectors have alignment in terms of the goals that they have. And I think we've seen a reasonable amount of success there. And lastly, I would say, but most importantly, we worked very closely with a number of the investors who've been mandated by the government to put capital out there, which is, the public sector banks who've been investing in PCG, TLTRO funding, as well as somebody like a SIDBI who's been funding some of these institutions, and we've played a role in terms of facilitating some of these conversations, especially because many of these investors have really not dealt with lower rated credits, right? So bank treasuries have largely played in the higher rated paper. So I think I would say absolutely sort of doubling down on our strategic priorities as always. So we've not diluted that at all, but doing it in a much more, I would say, calibrated and prudent manner.
Understood. Great. Thanks, Bama. Bhavan, how are you seeing retail investors behaving at this point in time from a lending perspective? You are a P2P platform. Do you see them being worried about investing in loan products, or do you see business as usual?
So Nirav, there was some kind of worry among the investor groups when it started. So in the end of March and I believe till end of April, when all the investors were witnessing such kind of scenario for the very first time, because P2P lending is relatively much newer compared to traditional banks and NBFCs in our country, right? So majority of the platforms started around 2015. So last 5 years has been the history, but such kind of incident never happened. So this worry was there. However, we had to allocate some more resources on explaining them. We were very proactive in terms of reaching out to them. The moment RBI announced moratorium, we immediately reached out to them by video explanation, audio explanation, and all. We tried to explain them the situation, that there is no meaning of panicking in any kind of investment. Panic makes you lost. So don't panic. Just wait and watch how things are panning out. And we have a strong team of 70-80 people, which is working on bringing the best returns for you guys. And I think we could convince them. And none of the investors hurriedly reached out to us or started pushing back any of our investment relationship manager that no, we want to take out money or something has to happen. So in short, that was the kind of steps which we had taken to manage the situation and educated them. Beyond that, since May, we have been facing even higher capital flow than what we used to face earlier. So earlier, let's say if our cash flow, capital availability at any point in time on platform is 5 to 6 crores, currently it is more than 15 crores. So that is the kind of flow of capital has been coming to the platform, and that kept growing as and when they started seeing the results in terms of either moratorium or EMI is being serviced by the borrower. So we were very proactive in terms of reaching out to borrowers as well. So though RBI guidelines around moratorium was not very clear in terms of how P2P lending platform has to act in this scenario, but then we thought it applies to each and everyone, and not less than 1% of borrower which follows under P2P loans will be able to understand it in a different way. So we took proactive steps. Again, we educated them, and for us, the average loan ticket size is around 15,000 rupees. So if borrower wants to pay moratorium charges, it hardly comes to 200, 300 rupees. So it wasn't a higher amount. Borrower could understand that. So both education and the small ticket could help reaching to those results. If we look at the way the repayments had happened in September and October, we have reached to almost same numbers which we used to achieve in pre-COVID time. October looks even better for all the loans which were originated between April to September. So I think nowadays the take-up which is happening in terms of loans is also taken by people after putting up a lot of thoughts. So earlier, I believe the consumption-oriented loans were taken by, influenced by their peer groups or looking around on the social media, etc. That, okay, I want to spend money on purchasing of this phone and all. I believe that on that front, people have become slight conscious because there is some kind of uncertainty in the market. But as far as the business parameters are concerned, we have not seen much bigger issues in terms of either investors nor on the borrower front.
And that's very heartening to hear, Bhavin. But you brought up an interesting point. I mean, you spoke about growth in demand and you spoke about growth in supply. I'd like to open up this question to a few of you, especially ones in the consumer business. How have you seen demand and how have you seen supply panning out, Akshay, during the last few months? You're on mute, Akshay.
So demand takes its own time to come in. What actually happens is, as most players come into cash conservative mode, the entire industry stops spending marketing dollar. So see, we rely on many of our partners to source customers. So let's say all the aggregators have to come in, Insurence has to go and spend money to acquire customers. As the pandemic started, they paused their marketing spend. So the industry started degrowing in the noise getting created to attract customers. That was on one side. On the other side, we really partner companies directly. So we are like we have access to 500 plus large corporates where we lend to the employees using a payroll finance technique or an access to an HR technique. Now, in that, we actually saw very high demand because the HRs came back and said, listen, we have these are the type of profiles of consumers and they are panicking or their employees are panicking for lack of cash flows. They're worried that they need to continue to make payments somewhere else. Can you still become the lender of preference? And we'll give you access to his payroll data so we can underwrite more. So we saw one business really skyrocketing. So let's say in pandemic, the first 100 days, we added a new company every day, right?
Wow.
So it's very tough to add a large corporate. Typical corporate has, let's say, 5,000 to 6,000 employees. And some of the corporates have, one of the employers that we just added has 4.5 lakh employees. Now, negotiating with an employer to get the product acceptance is very complex, but we had a huge run rate in the first 100 days coming in while the B2C business was slowing down. Now, what we are seeing as the overall business had some depth, we actually had more liquidity lying with us, which meant that you're carrying negative carry, but it's good to be negative in today's business so that you have more cash in bank for future growth. As the market is opening up, we have seen many lenders come to us and ask us take more. And in fact, the number of lines available today between on and off balance sheet is almost 2 times of what it was in March. So we have a lot more cash available to deploy, but we have to wait for the AUM to start rising again. My prediction is just after Diwali month, we should be started seeing growth in balance sheets again, right? And I'm actually looking at the entire consumer lending, direct lending space, right? And I expect AUM to start coming back. I think by January, we should be back at pre-COVID levels. And I think by March, we should be at least 60% higher than COVID numbers. And we're seeing that trajectory. For example, in the last 11 days on the platform, we have got close to 90,000 customers who came asking for money. So demand is actually back. And now it's really about, can we service the right customers? Of course, underwriting rules are more stringent. Lending to levered customer would be tougher. The NTC is far more easier to actually lend on. The levered customers are the larger risk parameter, and we need to grow as we're able to get more customers. So both the lines have to run quite well. Yeah.
Hi, can you hear me?
Yes, we can.
Okay. Sorry, I thought I lost some of you for a minute. I missed the last statement, Akshay. Could you kindly repeat that?
So I think, as I mentioned, demand has started picking up. We got almost 90,000 people in the first 11 days. We expect by March, which will be 60% higher than pre-COVID numbers. And of course, the portfolio quality is really showing the right indicators that we can raise more debt without any hiccups there. And there's enough pipeline available. I think maybe Bama can talk a lot more about what's the pipeline supply happening in consumer lending and what they feel, how comfortable are they to give more lines to players like us.
Well, I was about to come to Bama. Bama, how do you see the supply situation panning out, especially to NBFCs? And
Sure.
more specifically, do you see capital
I think it's a
markets?
very
Sorry, more specifically, do you see capital markets interested in, lending to these NBFCs, or are they more conservative today than they were earlier?
Absolutely. So just to kind of parse how the market graduated over the last 6 months, I think to begin with, we just saw a complete almost freeze for the better part of, I would say, April and May. Right, so we saw a few lenders were doing maybe a little more lending to existing customers, but really didn't see new capital coming in a big way and wasn't even sort of required. Post, I think the announcements of RBI around TLTRO 2.0, TLTRO 1.0 didn't really, do much. So I think 2.0, and more importantly, PCG. We started seeing some of the PSU banks getting active with the, I would say, the better rated NBFCs or the ones which had secured underlying. And that's really where we saw the credit appetite begin to come back. Towards the middle of Q2, we saw the traditional larger NBFCs come back into the market. So we ourselves, for example, started disbursing more towards July. We also had a number of the other NBFCs come back into the market in Q2. And very interestingly, as you asked, more recently, we've seen, I would say, interest coming back from the private wealth segment as well as to some extent from mutual funds. But at the same time, the interest is still very polarized towards better rated entities. So for instance, I would say the mutual fund market is clearly still looking at AA and maybe very, very selectively the A category. But there is appetite for credit enhanced structures. So for instance, if there is a lower rated issuer, and of course, Nirav, you're very familiar with this. If it's a lower rated issuer, but who's able to put together a capital market structure, such as, let's say, a covered bond, or if they're able to kind of do partially guaranteed bonds, or other kind of off-balance sheet structures with much higher levels of credit enhancement, I think there is appetite to look at those structures with some of the the capital markets players as well as the private banks. So I would say that I don't think the market is fully come back yet. On the consumer finance side, specifically to I think Akshay's question, I think it's the investors who understand the underlying who are ready to deploy even now. So for instance, you would probably see somebody like a Northern Arc and a few other larger NBFCs who understand this space, who are ready to kind of come in and take exposures, and primarily perhaps to work with existing clients. I think investors are wary of onboarding new clients, especially because they're not able to do, I would say, the kind of field diligence that they would prefer to do. A lot of it is through desktop diligences today. So till they're able to cover the field extensively and also get a sense of what the NBFC is really doing, it's probably a preference for existing customers. But yield seeking is definitely, so for instance, a similar behavior to what we heard in terms of liquidity coming back to the online platforms. I think investors are no longer entirely sitting on the fence. So there is definitely a preference to seek a higher level of yield. And there's also a recognition that they can't continue to deploy with the highest rated credit in the market. I think where the underlying sectors meet their requirements, so for instance, rural, agri, or if there is a sense that the product tenor is short term, so the tenor of the risk looks short term, and there is enough vintage of the underlying customer that the platform is able to demonstrate, for example, and there is data that's coming through. I think all of this is giving a lot of comfort to the lenders as well. But self-employed consumer, I would kind of echo the same sentiment. I think self-employed consumer is still something that causes concern. Probably there again, off-balance sheet structures with a lot of credit enhancement is where we would see more appetite.
Yeah. So it seems to me, from what you said and from what Akshay has been saying, that there seems to be demand coming back in at a rapid pace, but supply is something that is growing steadily. So it's not something that, so there is still this mismatch there. Now, given all of this mismatch and given the pandemic situation, I'm sure that credit risk models have been completely revamped and rewritten, so to speak. Mayank, how do you see financial institutions reassessing risk at this point in time? You're on mute, Mayank.
Can you hear me now?
Yes.
Yeah. So I was saying, I think the approach that we've seen that's completely changed right now, right, is I think they're asking for more income validation. I think there's still this feeling, both from a moratorium perspective and from employment, still if the person is employed or not perspective, they're asking more and more questions, right? And I'm talking large financial institutions. We'd sort of come to a point where there were processes and there were models in place, like you said, that were working quite well. I think those models are in question, and therefore, income validation, employment validation has just been added blanket to a lot of programs that didn't exist earlier, for example, right? And where there were models based on bureau and other information, alternative data, where they were quite comfortable. So I think that has definitely changed. Although what's happening is, I think post moratorium, as it is becoming, I mean, at least one EMI would have gone in for people. In some cases, multiple EMIs have gone in. For the segments that have paid well through the moratorium, right, the confidence is actually increasing. So that segment, I think the new.
I think we have lost, man.
I'm still here. Can you guys hear me?
Okay, yeah, go ahead.
Yeah. I was saying, I think for the segments where those segments that have done well through the moratorium that were continuing to pay, I think processes are improving significantly, and we're seeing much better sort of usage of just simple data like thickness of bureau being used. So, but that's still a very small segment, right? So I think for a segment we continue to use some of the existing models, but for most other segments, lenders are questioning and asking for more and more information and trying to understand if the person's employed still or not.
Right. Akshay,
can I step in there?
Yes.
Because it's a point of view and an interesting one actually for the audience also. So if I look at, we're looking at civil reports and talking about how credit behavior is actually showcased across banks, NBFCs, and then to fintechs. So while typically banks have X, let's say DPD 30, while NBFCs will have 2X of that, and fintechs were known to have 6 to 7 times of that. But that's not, but the way they look at customers are also different, right? First of all, the bank will get the most premium customer, NBFC get the next premium customer, and fintech, so to say, will get the next version of customer. But when you stop wearing the same hat and you start wearing the alternate data hat, where bureau data is actually quite defunct, it will not be that strong up to almost January next year, right? Because of the moratorium impact, they'll show it after 3 months how people repaid, etc. there. Which means that the alternate data pools of understanding consumer behavior, understanding their bank statements, understanding how the repayments happen, it's actually now becoming overarchingly more important. And when you put those lens and then you look at the players who have access to those data and how they look at portfolio behavior, we actually see many players have actually outperformed most traditional banks, right? And they've been able to do it really well, which means that if you're able to profile and slice your customers well, so like Mayank mentioned, many people drop their credit profile, many people raise their bar to say I will only lend to people upwards of 700 plus or 720 plus bureau, upwards of 35,000 salary. But the minute you have more data to understand repayments, people who paid throughout the moratorium, people who continue to have continuous salary, pre-COVID, during COVID, post-COVID, how the salary cycle behaved for them, industry and the segment, you have smaller segments which come out, which are like green pastures. And if you're able to go behind those green pastures, you can actually deploy a far greater amount of money and you actually are doing a profitable business. So today, there's going to be a clear shift taking place for players who are going to be focused on finding these niches, which are maybe, if you look from a distance, they don't look so large. But when you come inside, each niche adds up to become a large, compelling business object.
Sure. So, actually, from your perspective, right, how has early salary re-looked at risk and credit risk?
So, see, I think for us, 2 things are really good. The first is our ability to rewrite our scorecards. So, typically, a bank would take 3 years to redo scorecards. A new age company will take 6 to 9 months. We have a runtime scorecard, which means it corrects itself every 9 days. So, it's a new scorecard running. And we could keep improving in the COVID window. So, actually, if you look at, we only reduced lending for 9 days. Between 27th of March to 5th of April is when we had paused. And we restarted with the new scorecard, which started approving a higher pedigree customer, and it's now down to a similar pedigree. Of course, approval rates are slightly muted there, but the way we are able to handle risk is clearly indicating. So, like Mayank really mentioned, people who continue to pay during the pandemic are great to lend to, and we saw the portfolio that we are now attracting is almost 60% better than the pre-COVID portfolio, which means the customer quality is actually going up. which means that it'll become more profitable. So risk engines will hold true, and you can actually have a growth in business much faster than anticipated. So you can actually upgrade this customer from a 30,000 rupee loan to a 1.5 lakh rupee loan in a much faster cycle. Right? And that's actually fueling the entire part, and the market is looking far more comforting.
Right. Mama, on from your underwriting perspective, focus more on the large corporate segment or the NBFC segment. What changes have you implemented in Northern Arc?
So very similar kind of principles, Nirav, that we've looked at. So interestingly, I think when we started looking at metrics to understand, the institutional risk a little better, we looked at two dimensions. One, initially to begin with, was largely liquidity. And of course, today it's more about portfolio quality, capitalization, and potentially the risks to survival for some of the smaller, I would say, NBFCs. Our sense today is that a lot of these institutions have a significant margin of safety. So the way we've looked at it is coming off the moratorium in September. I think the kind of metrics we're looking at today is very similar to what Akshay was describing, which is what proportion of the customers of the NBFC have paid how many installments, right? So what proportion of the customers hasn't paid even a single installment? How many are, let's say, 3 down, 4 down? Irrespective of the moratorium, to get a sense of how distressed we think the customer base might be. But we're not forming any judgments purely based on that. So we're quite clear that the persistence of the moratorium itself could have led a lot of customers to conserve liquidity. So I think the idea is to now look at post-September. What are we seeing by way of recovery patterns? So is the NBFC really able to start bringing back customers to start paying? I think almost all of the NBFCs we speak to are basically focused on reducing the proportion of non-paying customers to say, let them start paying. So we don't expect to see a significant change in the PAR numbers immediately, but we certainly hope to see, I think, a gradual path towards recovery of the collection efficiency numbers. I think that's one. Second is basically the quality of data. And I think, I would say that at this point, institutions are also dealing with the complexities of having implemented the moratorium in the system. We still don't know what the verdict on interest is going to be. And if there are going to be further changes that people have to implement, etc., we hope not. But I think just understanding the integrity of data and also getting a sense of the loan level performance much better, I think is going to be important. Lastly, I would say, just coming off the situation, and there is, growth pressure for a lot of the NBFCs today. I think prudence in terms of further deployment, how they think about growth for the next few months and liquidity. Because I do believe that, while the recovery is visible, it's still fragile, right? And it could take a scare or two to, again, get investors back on the fence or to go cold for a while. So we would, certainly look for institutions to be prudent in terms of how they are managing their liquidity as well, irrespective of the growth and profit pressures. And I think that kind of financial discipline becomes extremely important at well-managed institutions. I think these are probably a few things that we would look for.
Interesting. So this also brings up a follow-on question as to how have you seen collection behavior in the last several months. Bhavan, how have you seen it happen on your platform?
Sure, Nirav. So I want to touch up on the previous question just in quick 2-3 sentences. Sure. So see, at Lending Club, we handle the similar problem in slight different way. So I thought it will be interesting to know for people as well. So what was our approach towards this problem is because there is a moratorium for next 3 months. I'm talking about we are in the end of March. So for next 3 months, we will not be able to understand a lot of parameters which were otherwise coming to my system and my models. Okay, so and there is no relevant history we had with the kind of situation we were foreseeing that this will last for 3 months, 6 months, or how people's behavior will be in such kind of situation, whether they will keep repaying, whether they will keep repaying only moratorium or similar likewise. So we avoided making any major changes in our algorithm which selects the borrower. However, some fundamental changes which we had done there, where we were selecting the borrower segment. So in borrower segment, we have one category where we say that this borrower is working in this industry. Because we were expecting that industries like travel and all will have impact over next 12 months, not only 3 or 6 months. And then the assumption was within 6 months, everything will be good. So we took this step, and then the next step which we had decided is, if moratorium is over in, let's say, June, then June plus 3 months. By that time, we will be able to see the clear trend in the market for my new customer as well as for existing customer, by which we will be able to change the real algorithm which we use to select the borrowers. And still that situation has not come. So apart from making those changes, which again we reset and went back to the same categories by starting of July, and we have been using the same model in choosing new as well as existing borrowers. And for us, the tenure varies between 3 to 5 months. So the results are also visible much faster than when it is deployed on the borrowers where you are giving 12 to 36 months or 48 months kind of tenure. And I believe that has so far helped. And if we look at the collection numbers, so before pre-COVID time, we used to collect around 94-95% of our dues in the same month, and then subsequently in the subsequent month. At this moment for September and now October, so in September, we have seen that number is reaching around 93%. For October, we are seeing that the trend should reach to 96-97%. So that's the reason in initial discussion I said that we are seeing the repayment pattern is improving compared to what it was earlier. The fundamental assumption behind our credit and risk team is that people have understood the importance of having credit. If similar situation, let's say if there is a second wave, third wave, or this lasts for long, they may require credit much frequently than what they used to require previously. So maybe they have become much more conscious. So that's from the income angle. Second, as they had received, they had got moratorium option. So a lot of people opted to pay for that. Again, thanks to our small ticket size, so the amount was not bigger. So huge number of people during first quarter paid their moratorium charges. And all those people subsequently, when their jobs were back, they started repaying their EMIs and they also received loan. So along with this part, we also allowed the existing customers to extend that tenure for 1 or 2 months when they come for the next loan, so that their next burden will not be as high as what it is today, so that their cash flow issues or worries will settle it down. And that has helped, and now we see results since last 2 months that the collection numbers are improving compared to even pre-COVID level.
Great. So, Bhavan, why do you see that happen? Collections improve compared to pre-COVID period? I mean, shouldn't it have theoretically been the opposite?
So see, as Bama said, all the crises are opportunities. So we also use this crisis to make it as an opportunity. So during last 6 months, we have worked a lot on of automation in terms of customer communication. Definitely it was there earlier as well, but when people get time to think on the problem solution will be much better than what it used to be in the normal course of action. So I think that is playing well. So now we are pinging or reaching out to customer when they generally open the email, check the notifications. During that time, we also started couple of processes at our end. So either through outsourced agency or with internal team, we initiated certain kind of calling procedure and then subsequently converted that into automated call. So first we gathered experience that how customers are interacting or behaving when we are initiating such kind of calls. Of course, these are more of educational purpose, that why you should protect your credit history, why you should be paying this on time, etc. And all these efforts are now paying back to us.
Right. So but that's an internal process, and which is great. But Akshay, let me ask you this: do you see a shift in the kind of consumer asking for loans now, given that banks and larger NBFCs probably are far more stringent in their credit parameters, and hence the quality of the customer that you're acquiring is better, and that is causing an improvement in collections? Would that be a fair assumption? You're still on mute, Akshay.
Hi, sorry. I think there are two parts here. As you improve your risk controls, you end up with better quality customers, which automatically results in improvement in collections capability. Right? That's hygiene of business. But you're right, man. The biggest component is as the traditional players are not yet back with full glory, this gives the opportunity for newer players who wanted to attract better customers can now go and service that customer out. But it also means 2-3 parts have to be done by players like us. One, we have to compete in a competitive market. We can't be charging higher because we have to shorten your product to break even on it. When you look at the better customer needs a longer repayment window, which means the net IRR on the product has to become extremely competitive. So I think that's the part we all have to play in. I think today 2-3 things happened. First is the consumer became extremely open to self-serve himself and himself going into a layer that there should be no physical interaction. I think we saw 2 elements. The higher the income customer, the better self-serve capability he accepted to. So let's say people who earn upwards of 60,000 rupees, we saw approval to dispersal within minutes without any human effort. Versus if we even did an IVR call to the customer, he didn't want to borrow. He wanted to do it himself. And that large shift is taking place in the modern higher customers, right? And we are seeing that as an angle that we can actually compete with the larger banks and NBFCs who actually have a lower cost of capital. By reducing our OpEx cost, we can compete and give a similar product offering to the last mile customer. So I think that's coming through. Yes.
Right, understood. Mayank, how about you? How are you seeing collection behavior and the quality of customers coming onto the platform? Are you seeing better customers come in compared to earlier times?
Actually, so on the collections bit, right, we don't get as involved on the collection side. So I have anecdotes on what's been happening with a lot of our partners. And I think one thing that I realized across the board was everybody was collecting a lot through the moratorium, right? So people started collecting even as the moratorium was being announced. People didn't stop collecting. I think that has helped a lot of those financial institutions, have very good collections. I mean, I think collections have been better than expectations through the moratorium for most lenders, right? So I think on the collections bit, we have that sort of flavor. But in terms of just pure quality, right, there are 2 dynamics playing out, like I think you guys were talking about. Definitely on the supply side, when the large lenders are not lending, there is an opportunity for the smaller lenders, the fintechs like ourselves to be able to, let's say, attract the high quality customer. But I think the other dynamic that we're also seeing is that demand has gone down significantly in the higher quality segments, right? Because a lot of that demand was, let's say, travel or consumption related, right? So someone's going to try and get their house repaired. Someone's going to travel and let's say wedding expenses. All of those seem to have come down. And so therefore, a large part of rather, the high quality demand is still not back, right? It is coming back, but there is a segment there which is not come back, right? People are spending way lesser on weddings. Travel is completely gone away. And, discretionary expense is also gone away for large parts, right? And so some of that high quality demand is also gone. So I think there are 2 opposing forces here, right? We're definitely seeing there might be, there is some movement from large lenders to, fintechs in general, because fintechs were lending through the moratorium and the lockdown, and fintechs were willing to give loans to people, let's say the banks were not comfortable to for a period of time. But on the other hand, there is this set of demand that is still not back, right? So I think the trade-off, I think we'll have to see how on net what sort of profiles come through, to the fintechs in general. But I think those 2 are definitely playing out.
Right. So, let's look at a concluding statement here. Right now, where do you see what next? Where are the new growth opportunities? Where do you see this? How do you see this panning out over the next 6 to 12 months? And where do you see the growth coming really for NBFCs in the lending space? Bama, maybe you want to start?
Sure, Nirav. So I think we think that there are definitely opportunities, in terms of white spaces, for instance, in the supply chain space, right? Where, for instance, you operate to some extent. We're actually seeing a lot of interest in investors looking at very cash flow driven structures. So a lot of the NBFCs would like to move from simply doing term loans on the balance sheet of entities to looking at slightly more nuanced structured products. I think that's one clear area. The second area where we think there's a lot of potential for scale up is anything related to agri, commodity, rural, and asset backed financing there. So we're seeing a lot of interest, and I think people have seen the resilience of that segment through the last few months, and both in terms of the credit demand as well as the collection behavior. And I think investors would want to build a deeper understanding of these segments and start deploying some capital towards that and build structures towards that as well. I think that's definitely another space where I think there's a lot of interest. And thirdly, I think just kind of responding to some of the trends and which may persist. I think one is clearly the greater shift towards e-commerce, products and structures related to that. I think clearly NBFCs are interested in understanding that much better. Increased demand there. And lastly, in terms of, assets which are being acquired in the context of personal transportation. So it could be, significant demand in two-wheeler, passenger cars. I think some of that, I think, is clearly going to persist. We're seeing, possibly more interest in electric, as an area where, again, we could see investors deploying some capital. So I think it's a combination of structures and underlying end uses that we'll see. To give you a sense of how the market panned out, post-demon, there was this shift towards balance sheet financing. And then post-ILFS, there was a shift towards off-balance sheet financing. I think post-COVID, investors are trying to figure out where their comfort and understanding lies. So it's, it could be a combination of balance sheet or off-balance sheet structures. But clearly, greater visibility on underlying is a theme that, I expect is going to definitely play out across all these areas of opportunity.
Right. No, absolutely. And we see that happen too. There's a lot more increased demand in underlying of large corporates rather than, and via that route funding MSMEs and SMEs rather than direct lending or term loan lending towards that. So, there has been an exponential growth in this area during COVID times, which for companies like Credible has been very hard. But from a sustenance perspective, I think that's an area that will continue to grow, given that people have now tasted blood in that space. Bhavan, where do you see the growth come from? I mean, in the next 6 to 12 months, especially in the P2P space.
So, we are focused on two segments. One is the salaried people's loan, where we give loan between 5,000 rupees to 15,000 rupees. And another segment is small business loan, where again we give loans between 5,000 rupees to 50,000 rupees. Average ticket size being around 35,000 rupees. So both of these segments are those where they face some kind of short-term liquidity crunch, and because of which they go for such kind of loan. Some portion of our loan also goes towards consumption. So 70% of this goes towards emergency or the liquidity solution issues, and around 30% is towards the consumption. So what we foresee is till the time the clarity on the COVID situation or 100% economical activity is back and everybody is back to their jobs, we foresee that the consumption may not go as to the level where it was in the pre-COVID time. As Mayank rightly said, that people who were availing loan for weddings or traveling, etc., definitely people are not going for that. So in last 6 months, we are already seeing that it is less than 5% of our total disbursement compared to around 30% previously. So we foresee that till that time, consumer consumption related loans are not going to pick up, but this kind of loans will pick up. At the same time, we see a good sizable emerge in the small business loans. And now we are seeing that earlier our customers were more of very micro businesses, right, whose monthly turnover is around 1.5 lakh kind of amount. But we are also seeing some sizable small businesses where the monthly turnover is around 5 to 10 lakh rupees, and they are also coming on board to us to get a loan of 50,000 rupees and all, which shows there is a stress on their liquidity. And we all know that it's a cycle. If that cycle has been interrupted at one place, their suppliers or their vendors will not be able to maintain the cycle. And that is clearly visible. So the scope which we see is in terms of salaried borrowers, the liquidity related loans, again, the same ticket size we want to focus, and we want to process across the geography. As I said, we have now expanded from 7 states to all the states of India. So that will give us next number jump. And on the small business side, we are creating a capability, or we are tying up with some partners who are doing similar kind of loans where our business interests are matching, and want to utilize our lenders' capital by giving loans to that segment, which we foresee in next 12 months is going to grow in much bigger way.
Great, understood. Mayank, how do you see this panning out in terms of growth for the sector?
So for us specifically, right, I think the focus has been working with larger financial institutions. What COVID has done, right, on both fronts, on the consumer front as well as on the large financial institution front, is one, I think digital, customers' willingness to do all the transactions digitally has gone up significantly, right? I mean, when we were doing like maybe 10-20% of our loans completely online, to now almost 60-70% of our loans end-to-end being done all digitally, I think that there is a big shift, right, on the consumer side. But the bigger shift, in our opinion, is actually on the lender side, right? Our conversation suddenly with a large bank like an HDFC or an Axis Bank are that, they are building the processes to have processes like CKYC, video KYC, eKYC embedded in their end-to-end, and underwriting end-to-end online. So I think what we are focusing largely on is trying to, build deeper integration with some of these larger financial institutions. Given the DSA market is so heavily impacted, I think our focus is that, we want to have a larger share of the pie with the existing, large lenders for us. But, on the larger market perspective, I think what we are going to see is an increase to pre-COVID levels over a period of time, right? I think expanding the pie in the personal lending segment might not happen for another 6-8 months, right? We might still go back to the old numbers for another 6-8 months, largely driven by consumption not being there as compared to, pre-COVID levels. Consumption significantly gone down in certain segments, and therefore I think personal lending will take its time to come back to old levels. But I think on that trajectory, we are looking to take a larger share in the pie in the meanwhile.
Great, understood. Actually, I know you have a contravening view to this. You believe that the growth will come back as soon as January and exponentially grow by March. How do you see that happening when demand for consumption is still low?
So I think, chase the demand also, that's very much important. So I think let's look at 3-4 things that we have done. I think first is we need to go and start talking with, let's say, the edtech companies, the consumer finance players, the Flipkart, Amazon, or online transaction platforms, and go behind the entire secondary product, which is, let's say, 30 to 1 lakh rupee on EMI for consumption. So we have really gone behind that category and said, this is the category that we said were not by us. In fact, during COVID, we have launched this entire new product line. We have added 9,000 merchants there. We have already started seeing a few thousand loans every week happening there. So we're already seeing that traction come in really fast. And we are confident that while we are maintaining the parameter, we only want to be salaried the segment, but we have to cater to all requirements of customers. So that's the first wave that we have gone behind. The second focus, that as we have become fairly well seasoned in the customers and the way we run, and our portfolio qualities is actually showing much better results than most players, we are more comfortable of doing even longer tenure loans now, which means that we can play the AUM game faster, which means balance sheet building will be exponentially better. The third driver, which I'm believing, is the on and off balance sheet. I think I would say sometime till a year and a half back, we all felt we had to migrate to on balance sheet plays. Now it's a 50-50. We need to run both. COVID has taught us that you need to partner when it comes to longer tenure, lower cost yields product with others, where the cost of capital is important, while on the other hand, where speed of giving money is more important, to deploy your own capital. So both these two parts, balancing convenience with IRR, means that we have to have both on and off balance sheet coming in. And I think these three things, when you combine the two, I'm pretty confident in a 12-month window, can we at least grow 8 to 9 times? I think we are very focused on that trajectory. As long as we can control our risk and we can demonstrate similar behavior to our lending partners and people who give us direct debt, both the sides, we are there to really build up the entire ecosystem.
Fantastic. That's very heartening to hear, Akshay. It's always great to hear a positive voice and a loud positive voice in what's happening around. So, look, it's been a fantastic discussion. Thank you all for being a part of the panel. It's there are mixed views, of course, as expected on how things would pan out over the next 6 months. But what's good to hear is that demand and supply are coming back. You're seeing uptake, at least on the small business, SME, MSME side. You're seeing more and more, participation from larger NBFCs, fintech platforms, and alternative investors like capital markets come in on certain specific segments. There are mixed opinions on how personal lending and consumer lending will go over the next 6 months, but I subscribe more from a view where you find the right customer, like Akshay said, and you would definitely see more offtake happen within that space. It's a great opportunity because the larger banks and larger NBFCs are far more stricter, far more process oriented. So time to disperse is much longer. So that provides great opportunities for new age companies to come in there and improve the entire customer experience. Of course, credit models have changed and hopefully for the good. There was a lot of fraud, as we all know, in this space, and it's this entire COVID experience has helped companies like Credible and all of us to rethink our entire credit strategy, and that of course would help over the next several years to come. So in conclusion, it's heartening to hear that good times seem to be around the corner, at least for the NBFC sector, as demand starts picking up and supply becomes a little more amenable to this demand. So thank you again, all of you, for participating on this panel. It's been an absolute pleasure having you here today. And thank you for your generosity to allow me to moderate it. I'm sure we'll catch each other offline, but till then, have a great day.
Thank you.
Thank you.
Thank you so much, all the eminent panelists and Mr. Neerav, for this insightful discussion on the lending opportunities beyond pandemic. Thank you so much for this panel discussion. And now we'll break for another break for networking and to visit the expo. And let's meet after that for the next panel discussion. And I assure you that it will be a great discussion to watch for.
भारत एक युवा देश है। विश्व में हमने युवाओं की आईटी एनर्जी के माध्यम से अपना एक रुतबा प्राप्त किया है और भारत इसके बात के लिए गर्व कर सकता है। दुनिया में हम आंख में आंख मिला करके बात कर सकते हैं। और ये मेरा साफ मैं हमेशा कहता आया हूँ, IT plus IT is equal to IT. Information technology plus Indian talent is equal to India tomorrow.
Today, sensitive data is everywhere. Data is located in many places, from on-premises data centers to the cloud. Siloed and legacy approaches can't quickly respond to evolving data privacy and protection regulations, and aren't addressing new hacker tactics, leaving organizations exposed. Data is being distributed across cloud and hybrid environments at accelerated rates to meet the demands of the growing remote workers, further adding to the complexity of protecting sensitive data. A piecemeal collection of data security products operated by an overburdened staff will never meet today's compliance and security challenges. An easier and unified approach to discover, protect, and control sensitive data everywhere is the only pragmatic way to protect your organizations at the rate and scale required by today's risks and transformation initiatives. Data security and compliance starts with finding your exposed sensitive data before hackers and auditors. This data can be in many forms: files, databases, and big data, and can rest across storage on your premises, in clouds, and across backups. Once you've identified databases and file systems that contain sensitive data, you can then apply data-centric protection, such as encryption, granular access controls, and tokenization. For encryption and tokenization to successfully secure sensitive data, the cryptographic keys themselves must be secured, managed, and controlled by your organization. Finally, virtually every data security regulation and mandate requires organizations to be able to monitor, detect, control, and report on authorized and unauthorized access to data and encryption keys. The CipherTrust Data Security Platform is an integrated suite of data-centric security products and solutions that unify data discovery, protection, and control in one solution. Thales has pushed the innovation envelope to remove complexity from deploying data security, accelerate time to compliance, and secure cloud migrations. The platform provides powerful tools to discover and classify the data that your organization should be protecting, protect against external threats and insider abuse with robust encryption.
I welcome all of you again after the networking break. And let's move on to the next panel discussion, which is on going forward, retargeting 5 trillion economy. And for this interesting topic, we have the panel of Mr. D.S. Tripathi, Managing Director and Chief Executive Officer of Aadhar Housing Finance Private Limited, Mr. Jugal Kataria, Group Controller, Satin Credit Care Network Limited, and the panel discussion will be moderated by Mr. Ashok Mittal, who is Chief Executive Officer in Pressed Loans. So I request Mr. Ashok to please take over from here and start this wonderful discussion on retargeting 5 trillion economy going forward.
Good evening, everyone, and welcome to the Elets Financial Services Virtual Summit 2020. First of all, I would like to thank Elets for giving this opportunity to me to be on the panel and also to moderate the panel. The topic for today is going forward, retargeting 5 trillion economy. So targeting 5 trillion economy from current sub 3 trillion economy is a very, very large target, I will say, and also a vast subject to talk upon. To discuss on this topic, we have Mr. D.S. Tripathi, who is the MD and CEO of Aadhar Housing Finance Limited. And we also have Mr. Jugal Kataria, Group Controller, Satin Credit Care Network Limited. Incidentally, in this panel, three of us are from, in a way, different segment. I handle MSME segment. Mr. Tripathi largely handles, let's say, housing finance, and Mr. Kataria handles MFI, and also they have multiple other streams. So this topic is not going to be limited to the areas where we operate into, but actually it's about the whole economy of the country, which might consist manufacturing, services, trading, agriculture, and all those aspects, all those areas which impact our economy. Our idea would be to understand this 5 trillion target, to understand how we are going to achieve, which are the segments which would be actually contributing, is it achievable, and what are the challenges we are going to face when we try to target it. So to begin with, I will say that all of us must introduce ourselves so that viewers or listeners, they can see what kind of people you are talking to, and then maybe take advantage of experience which other esteemed panelists have. So my name is Ashok Mittal. I am currently the founder and CEO of a NBFC company called Pressed Loans. We largely deal into MSME segment, which actually the first M of MSME, which is micro segment, which contributes almost say 95-97% of entire MSME segment. As you know, there are a lot of challenges both for this MSME segment, and our idea is to actually provide them easy and accessible credit. We are based out of Delhi. Before that, I have been a banker into banking and financial services with Union Bank, UCO Bank, other financial institutions for say almost 3 decades. I will request Mr. Tripathi to actually introduce himself, and then Jugal.
Yeah, thank you, Ashok. I am Devashankar Tripathi. I head Aadhar Housing Finance Limited, which is a low-income affordable housing finance company. This company, over a period of time, in last about 10 years, it started in 2011, and now it is the largest affordable housing finance company in the country in terms of its penetration and in terms of its AUM. And it deals actually primarily with the economically weaker section and low-income segment. We hardly have 7-8% of our portfolio to the middle income group, but largely EWS and LIG. And a major part of this is informal segment, informal sale ride, informal business people, because you know that India is predominantly an informal economy. So therefore, it is most befitting to that particular economy, because it started with the collaboration with the International Finance Corporation, and that's why the theme and objective taken by the Aadhar Housing Finance was like that. Prior to joining Aadhar Housing Finance for 7 years, I was with Union Bank. I have been a practicing banker for about 37 years prior to joining Aadhar Housing Finance.
Great.
That is about
great.
Thank you, Mr. Mittal. Good evening, everyone. I am Jugal Kataria. I am Group Controller at Satin Credit Care Network Limited. We are a Delhi Gurgaon based NBFC MFI primarily. and have 3 wholly owned subsidiaries. We have a small housing finance business, MSME arm. We do business component activity. At a group level, we have close to about 8,000 crore asset under management, out of which roughly 7-8% as non-microfinance and primarily focusing into microfinance. By profession, I'm a chartered accountant, cost accountant, and company secretary, working for 20 years with Satin Group. And prior to that, I worked with Apollo Tires and participated into financial, into their different verticals. So that's my background. Thank you, and look forward to our discussion. Thank you.
Thank you so much. I think a good amount of experience with this panel. So I will just quickly jump on the subject which has been given to us, 5 trillion economy. So I would want to ask both of you, and then maybe turn by turn you can reply this. What is this 5 trillion economy? Why is it so important? Why we are saying 5 trillion economy? Why? Why 5? And what is the importance of this 5 trillion economy? What will happen if when we achieve this, I will say magical number, because everybody is talking about it. Because when I look at the numbers, this is not the first time when we are talking almost doubling the GDP. So from 2005 to 2010, in those 5 years, economy went from say close to $800 billion to $1.6 trillion, which means in 5 years is actually doubled. However, from 2010 to 2015, when we talk, it went from 1.6 trillion to 2.1 trillion only. So it actually did not double. It was say close to say 50% or so. And then in last 5 years, from 2015 to 2020, it is from say 2.1 trillion dollar to 2.9 trillion dollar. We have not been able to sustain that $3 trillion mark so far. And now we say, okay, I'm sure, I know that we are talking during this COVID period when everybody is down and there is a lot of concern about economy. But still, if we say, okay, we want to double from here, almost double from less than 3 to 5 trillion dollar in say about 5 years or so. So what is the significance? What do you feel at a broad level? And then we will go maybe a little micro about it. Mr. Tripathi, you can start.
Yeah, thank you, Ashok. Why is significance of having a 5 trillion or 10 trillion economy going forward? I'll give just a slight analogy with China. China's population is 142 crore. India's population is 135 crore. Gross domestic product, that is a GDP of India, is now around $3 trillion, while China is $14 trillion. This but clearly signifies that India's per capita income is $1,900 only, while the China's per capita income is $9,400. It means if China's economy is 5 times of our economy, that in terms of GDP, it clearly says the per capita income of the people is 5 times in China what we have. That shows that large number of our people are living under poverty or in a very, very difficult situation. Even if they are above poverty, they are not living in a very decent environment. So growth in the economy clearly signifies that how the people of the country will have a decent way of living. That is the whole thing. Even if we reach 5 trillion economy, our per capita income will go to $3,600. Even then we will be a medium class people economy, not we are going to be a developed economy. The whole idea is that you have already mentioned that 2014 it was 1.87 trillion, and in 6 years we could reach close to $3 trillion. Now increasing $2 trillion by 2025, in next 4 years time, going from March 21, because this year we should not count, this is a disaster because of COVID, and let us not go into the gloom and doom of the COVID. If from April 21 things improve, then we have precisely 4 years. Whether we will be able to reach there at that point of time or not. Now, another number I would like to give you, India is in no way lagging in certain things. in terms of milk, in terms of cotton, in terms of lot of horticulture product, in terms of spices, we are number one in the world. In terms of startup, we are the largest country in the startup. In terms of wheat production, rice production, meat production, in terms of the so many other items, sugar, we are number 2 in the world. And still with a population of 135 billion, we have large number of people who are having $1.9 per day income. That is nothing for a normal living. So that is why for the country like India, the growth in economy is important. Second point, you asked, very valid point. What does it mean? If the 5 trillion economy becomes by a number when only few people increases their lot and majority doesn't get, it doesn't serve the purpose. Unless the benefit of the growth of the economy to 5 trillion or 10 trillion in 2030 translates to large number of people, it has no meaning. That's why the ease of living is equally important when we talk the ease of doing business to achieve 5 trillion economy. And when we talk of ease of living, the large number of population, maybe around 40-50 crore people, they are neither having the health care, not proper education, not proper food, not proper nutrition, neither sanitation, not housing. The large number of deficiencies are prevailing there. If the country has to really become a prosperous country, at least for a middle class country, which actually the Bain's study clearly shows that 40-50 million people in India are today in middle class. There may be 400 to 500 million people by 2030. If that happens, then probably we can boost that my large number of people are having a graceful way of living. So now when the government thinks of 5 trillion economy, this is a very important number, which Prime Minister has showed very aspirational number, because unless you put a target, you can't work backward behind that. So that's why I must admire the government of the day that they thought of it. And once they thought of, they're working on that. It's not they're not working on that. Now the questions comes how, when in 6 years we could grow by about 1.2 trillion, how we will go 2 trillion in 4 years. If you take the story of China in 2006 was 2.7 trillion economy. In 2009, it became 5.1 trillion economy. The China has showed us in 4 years, they can reach the number which we are actually aspiring. But only thing that China had a lot of enabling environment before 2006 to reach that number. Do we have that? I think that we will discuss going forward, because a lot of steps has been taken in last 6-7 years, and even previous years also. Every government has taken a step, but the major steps have been taken to see that how we reach there. So the most important thing, that the enabling environment has to be created. I will just touch a few more points. Agriculture contributes only 15% of GDP, while 56 and 58% people are living on that. That shows clear-cut unemployment or underemployment and clear-cut undernourishment or poor living of those people. Second comes
sorry, we will come to this. I have this question separately to ask you about the segments. But
no, I hand over to Jugal to give his views. Then I will contribute to that.
So because Mr. Tripathi has raised this one point. Okay, 5 trillion means the larger population which is deprived, or larger population should get benefit of economy when we reach a $5 trillion. Yes, Jugal, please. What is your view on this? What is your take?
Sure. Thanks. So I think this topic and the timing of discussion is very important and appropriate. When in mid 2019, when the Prime Minister said that we should aim for 5 trillion by 2025, the economy was less than trillion, and at that point in time also the target was to double the economy in a period of 5 years. Itself was a very challenging target. The economy has to grow at roughly 11.5% to 12.5% depending upon inflation and US INR exchange rate, etc., because the target was fixed in dollar terms. So it was a very difficult target, not have too many precedents globally in the past, where countries have grown at this pace continuously for year after year. China has demonstrated that for some point in time. India has also achieved, double-digit or close to double-digit growth in some years. But doing that continuously year after year for 5 years in a row is surely a very challenging task. Having said that, setting a target and then you aim to go into a different league, or 4 economies in the world, it cannot be business as usual. One, that the target has to be aspirational, and you have to do drastic measures. COVID has impacted, and the global the supply chain is getting realigned. So I think this is very important that we think as to how we want to reach there. We surely has lost one important year, which is almost 20%, then 10-11% growth, going to degrow by roughly 10%. So the target has become much more challenging, but surely we should aim towards that and strategize and implement. As Mr. Tripathi said, China has demonstrated that this is achievable in 4 years.
Correct.
So we should also aim for that.
Great. So I think there are 2 aspects of this. One is if the economy grows to whatever level, and especially to 5 trillion, we see that the masses, the underprivileged, the people who have not been able to take advantage of growth of the economy, they will also be able to take the advantage. 2 is maybe at a what Jugal says, at a global level, our presence, the each sector of the economy will grow, and that will automatically put the country in a position globally which is desired by all the people in the country, I guess. Good. Second question which Mr. Tripathi was talking was, and this is how I would like to ask him also, that former National Development Bank Chief Mr. K.V. Kamath, he expressed confidence and in the ambition which we have that, okay, we will become 5 trillion economy in the next 5 years. Now, okay, we will become, or we will try to become, we will put our efforts to become 5 trillion economy, and in the next 4 years now, I will say. So who will contribute how much? What is your sense in that? Because when we look at this segment which we are currently, let's say, contributing to the economy, whether it is manufacturing or trading or IT services, agriculture, financial services, and as Mr. Tripathi was about to say that, so agriculture is highest, but at say maybe 15-16%. Then you have public administration services, then you have manufacturing or close to 12%, then you have construction and mining. So when I say these segments who are, let's say, contributing significantly to the growth of economy, I'm sure to all of them, the financial services sector, let's say banks or BFSI sector, contributes a lot in terms of enabling them to achieve that growth. So when you provide finance to the agriculture sector, you provide finance to the manufacturing sector or construction or mining, that is where the economy will, let's say, grow. And so do you see any change happening in any of these compositions which we currently have, any particular segment which will grow very fast and actually help us to reach that $5 trillion? Or you think the percentage would remain largely the same which we currently have? Do you think we are having any segments or sectors which are missing and which we should include in the GDP so that the numbers are more relevant? I mean, this percentage or the composition, I want to be a little more specific. If you can share your views, please.
I have to, Ashok or Jugal?
Mr. Tripathi, you can start. No problem.
Yeah, actually, the very valid point you raised about K.V. Kamath. I think K.V. Kamath, what he has said, that perfectly fine. It may happen 2025 or 2025, 26. That doesn't matter. The main theme is that 5 trillion economy, and as early as possible. I just mentioned about in my first talk that agriculture. Agriculture, we have given a lot of focus on production. Today, we are having a problem of plenty in agriculture. Now, time has come that we have to focus more on increasing the income of the farm people. And that's why a theme is doubling of income of the farm people. Because if you continuously increase the production, the farmers will not get the proper income of that. So the three farm reforms which Government of India has recently done in the last session, these are having a significance. Forget about what debate is going on, but these reforms are aiming from production to increase in the income. Because if we are talking about 5 trillion economy, the income has to increase. And that is now largely not only focusing on how to do the marketing of those things, it is aiming on the processing of the agriculture products, the one market of the entire country instead of having APMC. This is the Commodity Act removal. And more importantly, it talks about rural infra spending. So if large amount of 1 lakh crore, which is in Atmanirbhar Bharat, the tranche 2 and 3, the Government of India had 3 and 4, Government of India had just mentioned, then 1 lakh crore they have to spend. So they have taken plethora of things, not only the direct agriculture swing, but they have taken all the allied activities, the fisheries, horticulture, dairy, everything they have taken, and they have thought more that it should be done in a more of a corporate way so that the farmer can get the remunerating pricing. So one part is agriculture. Second part comes now the industry. Agriculture, of course, partly contributes to industry also, but industry is one of the important things that we are, unless you grow the manufacturing sector, and you cannot dream of having a 5 trillion economy. With 25% contribution of agriculture manufacturing sector in the economy and depending more on service sector, it's a dream. So 5 trillion economy or any growth in the economy, because keep going 5 trillion, as Mr. Jugal has mentioned, depending on exchange rate, you have to grow in nominal terms for about 11-12%, and in terms of the real term 8 to 9% next 4 years. So that requires one huge spending on infrastructure, for which 100 lakhs crore rupees Government of India has already made a target, and every day I think Prime Minister is inaugurating the one or other infra project. Second comes the unshackling of the MSME. MSME is the core sector for the India, not only for the India, for the globally for every country. In India, large employment, roughly about 11-12 crore rupees people are employed in agriculture, in MSME. 6.3 crore units are there. Largely 95% are not registered, which are informal. They are not much borrowing. And more importantly, 30% GDP contribution alone comes from MSME. And then the MSME also have 48% contribution in export. So if MSME is taken proper care, you are taking care of employment. Next to agriculture, employment is going from MSME. Second, you are going to take care of the export. And third, you are going to grow GDP. And that's the reason the government has already increased the eligibility limit of MSME from 25 crore, 50 crore loan amount, from 100 crore rupees turnover to 50 crore turnover. All those measures have already been announced. And to see that, and MSME gets impacted because of pandemic, and so many issues are there because MSME is very resilient to economy and very prone to various things like agriculture. 3 lakhs crore emergency credit line, of which around 1.8 lakhs crore is disbursed, that is in that direction. And not only that, the capital infusion is planned for MSME. The NPA MSMEs are given to subordinate debt. So many measures the government is taking. How these measures are going to be impactful, they will decide the growth of the economy. And the fourth is export. Without export, thinking of 9% growth continuously is a dream. Domestic economy is very good. We have a large domestic economy, but alone domestic economy cannot help unless you have an export, because export give you 3 to 4 times of the cost coming back. Because whatever you sell in India, you can get 3-4 times money out of that. Whether export of IT, export of services, export of manufacturing goods. And one, I think I will touch this point also, then Jugal will take over, for manufacturing. You see, in manufacturing, today's environment after the pandemic between US and China, earlier US has been consumer, China has been the supplier. Today, most of the countries of the world are going to be consumer, not only US. And lot of manufacturing sector is likely to move out. How much we will get, that is again a matter of time, how government takes the step in that. how much other countries are getting, but still Bangladesh and Thailand and some other countries, Philippines, some other countries are taking major share in textile and that. I think government has to create a very important enabling environment to attract FDI, because investment is one thing which can only take the economy to 5 trillion. Investment has to go to 41%. It cannot slog at 34-33%. And for that, private sector has to be heavily encouraged. I will stop here. There are other points to discuss, but I will request Jugal to contribute something. Then we will debate on that.
So Jugal, before we start, I'm still struggling to find out, and if you can help me to understand this. These various components: infrastructure, manufacturing, MSME, export, agriculture, construction or mining, who are, let's say, various components within the GDP. Do you think any shift happening? And you can also maybe include if how much financial services will help them to achieve those numbers, or you think this percentage or ratio would largely remain same? Is there like out of the box or some other kind of thought you have in your mind?
Sure. So I think it is a very difficult question to answer to my mind. I'll just take 1 minute before I come to that. What has happened that we have lost a very important 1 year out of the 5 years. So 20% of time we have lost. We were aiming for 11-12% to reach that this time. This year has given that there'll be a negative growth of around 9.5%. So we have probably pushed that target even in the normal circumstances. We should aim for reaching there in 4 years now, which means that now we have to grow at 17-18% year on year in case we want to reach, still in 24-25. So that is one important. So in case we have to reach there, there's one important point that COVID has impacted the world uniformly. There might be some countries which are slightly less impacted, some countries are slightly more impacted. But fundamentally, it has impacted everybody. And the India's own story of domestic growth, consumption, ease of doing business focus, regulatory reform, so on and so. So government has done some work which will have a long-term, so to say, impact on the growth of the economy. These structural changes may not bring, so to say, progress or result very quickly. Having said that, so we have to attack all angles, both, make in India, exports, as Mr. Tripathi said, so on and so forth. It is very easy to say that, we should reduce import and work on the domestic thing and all. Till the time we'll be globally competitive, till the time we will produce quality, right quantity at a right price, the dependence on import will not go down. Similarly, export will not go up till the time we address these issues. Government has been spending money on infrastructure development, regulatory reforms. We have come up the ladder on, ease of doing business drastically. Having said that, some groundwork has already been done and a lot more needs to be done, both on manufacturing and on services side. To my because only then, we'll be able to achieve 17-18% kind of a growth. Agriculture may not, though we are primarily an agricultural economy. My sense is that over dependence on agriculture will not take us that far. So we have to give importance, equal weightage to both, manufacturing and services, and which will help us grow over a period of time. Of course, financial services has to play a very important role. A little bit more regulatory reforms in terms of, to grow NBFCs, to have access to deposit, etc., or to have access to funding, etc., surely will help other sectors to grow fast, because most of the small MSMEs keep struggling for money in case somebody is borrowing at 12, 13, 14%, growing business is challenge. So these structural, changes are required.
Thank you so much. I think I would also like to put a little bit of my view here in this specific context. Track growth, which we are looking at, and we are talking about growing the economy despite of COVID being there and a lot of fear about growth of the economy being there. That mindset, and I think we can represent India from that perspective, is itself is very important. So if we can still talk about it and still be positive about it, it is achievable. My sense is that going forward, if we have to really achieve it faster, the services would have to contribute more, because India is in a way earlier where over a period of time the contribution from services, be it export services or whatever, has been increasing. And I think the way we think, if we to largely depend on agriculture commodities or agri, that percentage in my view would fall. So we might we might witness or see a change in the composition which we are currently seeing as far as the 5 trillion economy is concerned. So when we reach at say 5 trillion, I think this percentage would change somewhere, and we might see that services being at the top with a higher percentage of contribution, and that is the only way we can do it faster. If we have to increase the farmers' income, or let's say double the income, then we have to focus more on increase in the yield from the same land, because land size you cannot increase. So there has been, say, I will say, a lot of efforts in that, but then there are also a lot of issues whenever government or any other agency tries to increase the yield by GM crops or by using, say, any kind of technology, then there are a lot of issues as well. Right now also we have seen a lot of issues when government comes out with, say, bills for, let us say, supporting the farmers, then there is a lot of politics as well on that. Great point. I think my sense is this composition will change. Let us see how it actually really happens. Another point, and this time again I'll go back and ask Jugal to start, is of course this is going to be challenging, right? So there would be challenges which both of you already mentioned. Which kind of factors would impact more or have bigger challenge than, and also the challenges will be lesser? Say for example, whether pandemic, which you already mentioned, it has impacted, let's say, almost 20% of the thing because 1 year is gone. But let us say 5 years now. So whether global factors will be more forceful and they will impact whether we grow or not grow, whether they will be like local factors within the country, whether they will be financial issues or there will be political issues. How long you think COVID impact will keep impacting us? Someday will come when we'll stop talking about COVID and say, okay, now that is past. So how it will be driven? I mean, can it automatically happen because of something happening globally? So whether global factor, local factor, COVID, what do you think? Which are the factors which are more forceful in this? This time, Jugal to start.
Sure. I think both global and domestic factor will play important. Now living in an isolated economy,